individual and business tax lessons. So we have Sule from IRAS who will start the lesson. Yeah, later on, there'll be a break at 11 a.m. and we have another trainer, Lee Hoon, who will be joining us to share on business tax. So in between, if you need to go the washroom, do go ahead. Yeah. Okay. So let's start the lesson. Thank you.
Share screen, right?
Yes.
So here, can see my screen now?
Oops.
Not yet. Cannot see the screen yet, you know.
Cannot see the screen yet.
Can see you only.
Can see or not? Huh?
No.
No way.
I supposed to take over the share screen.
I think you just stop screen. Do you stop screen first?
Okay, I stop.
Then you share again. Yeah, can see now.
Now can see? Now can see or not?
Yes.
Can see, but it's not slides presentation.
Yeah.
Okay. And can see the notes?
Yeah, can see the notes. Don't have really.
Yeah.
Okay. Okay, let's begin. Good morning, everyone. My name is Sule. Before I begin, let me have a quick introduction on myself. I'm with the IRAS Individual Income Tax Division for over 20 years. Okay, I've been doing policy reviews and rules review as well as giving interpretations of income tax for officers as well as external parties. Today, we will, I'll go through module 5 first, and then thereafter, Li-Eng will continue with module 4. You may be wondering why we start with module 5 and not module 4. Okay, basically it's because module 5 gives you foundations of individual income tax treatments. It will apply to self-employed as well, which is covered in the later module. Self-employed is in the partners or sole proprietor. Okay, module 5 will have these. We will cover the tax residence status, tax exemptions, personal relief, tax rates, which are all applicable to individuals, including self-employed persons. Individual may be exercising employment as well as carrying on a trade concurrently. So for tax purposes, this income will be aggregated together and taxed under personal income tax rate. For example, directors of a company can also set up another partnership with another person, so he would derive employment income as well as partnership income. So in this case, this income will be assessed under individual income tax rate. Okay, today I will cover tax residence of individuals, and I will elaborate the importance of resident status. I think a lot of slides will be on taxation and employment income. You know that most of us actually derive employment income, and most individuals' main source of income is from employment. So we will spend a fair bit of time on talking about how do we assess employment income and the tax principle relating to assessment of employment income. Also the deductions of expenses against employment income. Thereafter, we will move on to taxations of other income. We will focus on the withdrawal from supplementary retirement scheme, which is a scheme that applicable to individuals, and we'll briefly touch on the exemptions of locally sourced investment income. Thereafter, I will just cover and give you an overview of personal release and parenthood tax rebate. These personal reliefs are quite straightforward. Conditions are all given, so I will not elaborate much on personal release. Okay, lastly, we'll go through one case study. Okay, along the way, if you have any questions, you can post a question on the chat box. If I have the time, I'll try to answer your questions. Okay, we will start with tax resident status of individuals. Tax resident status has implication on the person's tax liability. Whether you're resident or non-resident, there are implications. So what is the definition of tax residence is defined in Section 2 of the Income Tax Act. You can see from the screen, definition is provided there. It is quite lengthy. Okay, you may not be able to memorize the whole sentence, but bear in mind, I think importantly, you must at least remember the keywords, those underlined keywords. Okay, the first one is person who in the year preceding the year assessment resides in Singapore except for such temporary absence as may be reasonable and not inconsistent with the claim by such person. So here the keywords would be absence must be temporarily, and it must be reasonable, and it cannot be inconsistent with the claim by such persons to be resident. Okay, this is the first limb. Okay, the second limb would be the next one. The next bullet point is includes a person who is physically present or who exercise employment. Okay, the bracket is other than a director of a company, like would not. So the second limb would not apply to a director in Singapore for 183 days or more. Again, the keyword here would be physical present or exercise employment. This refers to durations of the person. Either you physical present in Singapore or you exercise employment in Singapore, and the duration must be at least 183 days. Okay, so you can see the difference between the two limbs, okay, actually refers to the so-called qualitative test and quantitative test. Qualitative test, we look at whether the person is usually staying in Singapore. Okay, you may look at also other things, other factors like family ties of the person in Singapore, whether he has any business in Singapore and where he normally resides. Okay, so if a Singaporean whose family ties in Singapore would generally satisfy the qualitative test, even he has been posted to work in overseas for a few years. Because for tax purposes, we treat this person's absence as temporary. Okay, since your roots is in Singapore, you will return to Singapore one day. Okay, so we will treat a Singaporean as resident unless otherwise that the facts given is such that the person has been absent for many years and we don't see that the person has any intention to return to Singapore, then we may treat the person as non-resident. Okay, the second limb, as what I mentioned earlier on, is about durations of employment or durations of physical presence. That is called quantitative test. Quantitative tests look at the number of days a person present in Singapore. So under this test, if a person fails the qualitative test, if he can show that he actually physically present in Singapore for 183 days or more, or if he working in Singapore for more than 183 days, then that person can be treated as a resident. So this test is generally applies to foreigner, okay, who come to Singapore to stay or to work. Okay, even if a person fails the two tests, okay, qualitative, quantitative, you don't satisfy that, we still have admin concessions, the 2-year and 3-year admin concession. So we, as much as we can, we apply this concession to treat the person as resident, so that that tax liability will not be the same. Okay, the 2 years admin concessions actually refers to a person exercise employment in Singapore for a continuous period for at least 183 days, straddling 2 consecutive years. Okay, not worry, we'll show you the example later how do we apply the 2-year concessions. And the 3-year concessions is actually looking at the 3 consecutive years. The first year, second year, and third year. Okay, usually the first year, the person is staying in Singapore for less than 183 days, and the last year, the third year, also less than 183 days. But the second year, he or she was in Singapore for the full year. So by having a 3-year concessions, we can treat the person as a resident for the first year, second year, and the third year. Okay, so now we will illustrate how we apply the 2-year and 3-year concessions here. Okay, I will use this. Okay, in this case, that foreigner arrived in Singapore on 1st September 2020. Right, so if you look at 2020 itself, he's in Singapore for less than 183 days. It's just 4 months. So technically, he's a non-resident for year of assessment 2021. The basis period is 2020, it's less than 183 days. It's 122 days. So if he continuously working in Singapore until at least 2021 March, that he can show that he was working in Singapore for more than 183 days consecutively from 1st September 2020 to at least, okay, may not be 31st March, it could be just second or as long as he hit more than at least 183 days under the 2-year admin concessions, then we'll treat the person as a resident for tax purpose for year assessment 2021 and 2022 as a resident. Okay, this is the 2-year admin concession. And for the 3-year admin concessions, if a person continues to stay in Singapore for the whole year of 2021, and then he left Singapore on 31st March 2022. So if we were to look at each year by itself, you notice the first year is less than 183 days, and third year is also less than 183 days. So strictly under the law, the person will be assessed as a non-resident for first year and the last by 8, except for the second year where he was in Singapore for 365 days. But under the 3-year admin concessions, we will assess the person as a resident for the first year, second year, and third year. Right? You may be wondering, since we already have a 2-year admin concession, why do we want to have a 3-year admin concession? Isn't a 2-year admin concession is good enough? In fact, IRAS had the 3-year admin concession much earlier than the 2-year admin concession. The 3-year concession was started probably more than 20 or 30 years ago, and it's mainly to cover the the person actually in 3 years, first year and third year not satisfy the resident test. Thereafter, I think in the 1990s, okay, we have this 2-year admin concession introduced to help those foreign worker who was in Singapore and ended their employment contract under unexpected circumstances. So if we can only apply 3 years, these foreign workers will be taxed heavily because they did not satisfy the residency tax. 2-year admin concessions is actually for those who are in Singapore for a shorter period of time, right? Here, okay, so much for residency test. We will have a short quiz on how you determine resident status. Okay, I'll launch a poll. Okay, I want to know how much you actually understand how you apply residency test. Okay, in this question, a foreign employee, okay, I'll launch a poll. You can read the question, right? Foreign employee will arrive and start work in Singapore 2nd October 2021. What are possible cessation dates for him to be assessed as a resident for the year of 2020? Oh, I haven't launched a poll yet. I can't do this one. This one is okay. We launch a poll. Yeah, I launch.
Okay, can see.
Okay.
Yeah.
Okay, the hint is more than 2 dates, okay. So you can choose. Okay, I will end the poll here. Right. I'm going to share the results. Have you done? Are you all done? Okay, I end the poll here. %. Okay, on B and 26% on C. Okay, I stop the sharing. Okay, the answer, can you see the answer? Yeah. Okay, answer is B and C. Okay, only B and C that the person actually completed the, satisfied the 183 days conditions, right? From October to March is less than 183 days. But if he worked until 31st May, he will satisfy the 183 days conditions. No issue for C because he worked more than a year. So it's for B and C. Correct answer is B and C. I think I can. Okay, another quiz again. I'm going to launch a poll again. Okay, this was your answer. The foreigner was physically present in Singapore since 20th November 2021. He was later offered a job and commenced his employment in Singapore on 2nd January 2022. If he had ceased employment on 15 June 2022 and left Singapore on June 2022, what is his tax resident status for YA 2023? Okay, I will end the poll here. I'll show you the result. Wow, 80% got it wrong. Only 20% get it right. Okay, the result. Okay, okay, I will stop sharing this result. Okay, the correct answer is B. Why is that so? Okay. Remember, I explained earlier on the 2-year earning concession refers to a person exercising employment, not a person physically present straddling the 2 years, 183 days. In this example, right, the foreigner started working in January, 2nd January. So from 2nd January to June, it's actually less than 183 days. So he cannot be treated as a resident for year assessment 2023. Okay. Okay. Why resident status is important? I'm going through to give you a comparisons of tax treatments for resident and non-resident. Okay, from this table you can see, right? If you are a resident, the person will be taxed at progressive tax rate, right, ranging from 0 to 22%. Your chargeable income will be taxed from 0 to 22%. 0 is for the first 20,000 chargeable income is tax exempt. Of course, there's a revisions of progressive tax rate from YA 2024 onwards. It's from 0 to 24%. But this change is mainly for the high income, okay, for those above 1 million. And if you are non-resident, okay, the tax rate will be at the flat rate of 22%. And from year assessment 2024 onwards is 24%. There are exceptions for non-resident. These exceptions applies to those who exercise profession vocations. Non-resident who exercise a profession in Singapore, the income is taxed at 15% flat rate. Public entertainer also will be taxed at 15%. There are some concession rate which is 10% for a specific period of time, but it's already ended on 31st March 2022. Okay, as for employment income, our main concern, employment income. If you are non-resident, your employment income will be taxed at a flat rate of 15%, no personal reliefs, okay? Of course, if you are a very high income earner, such that if we tax you 15%, actually give you a lower tax liability than taxing you as a resident, then we will apply progressive tax rate to the person. Although he is a non-resident, right? This is provided for under Section 40B(2) of the Income Tax Act. Okay, the next difference is, as I explained, is the personal reliefs. If you're a resident, you can claim personal reliefs. You know, personal reliefs are earned income relief, spouse relief, your CPA contributions, child relief, so on and so forth. But if you're not resident, okay, there's no personal relief for you, right? Okay, the next difference that we can see from the treatment for resident and non-resident is the exemption of short-term employment. Okay, one thing good for non-resident is there is exemptions if for the employment income if you in Singapore for 60 days or less, 2 months or less. If you work here less than 2 months or not more than 60 days, then that employment income is not taxable in Singapore. For resident, there's no such exemptions, right? Because you are saying here, right? Okay, whether you work 1 day or work 60 days or 183 days, there's no difference. Your income will be subject to tax. That exemptions for non-resident 13(6), right, under section 13(6), it will not apply to directors again and public entertainers. We know public entertainers don't actually need to stay in Singapore for very long, right? So the 60 days exemption will not apply to them. Next one will be the double taxation release under double tax agreement. So Singapore actually have concluded a number of tax treaties with various countries or tax jurisdictions. So if you are residents and you happen to work in work in other country and suffer tax there, the so-called the tax relief, right, or tax credit under the tax treaty may apply to you, and to so that you may not have to suffer the tax twice. Okay, in a way that we don't let the person to be pay tax twice on the same income. Okay, if the other country has the right to tax your income, then we do not tax you. Or if we have the right to tax the income and the other country tax you, we may give you a tax credit. Okay, this tax benefits under the DTA will not apply to non-resident individuals. Okay, next one will be the income arising outside Singapore, the tax exemptions. So if you are a tax resident, tax exemptions are applicable to income derived from overseas, meaning foreign source income. Under section 13(7)(a), if you are a resident, you actually receive income, overseas income, foreign source income, then that income is exempt from tax. Exception is income you receive through a partnership in Singapore. Okay, for non-resident, all the foreign source income is not taxable. Any questions on this? Oh, there's a question of whether we provide progressive tax rate table. We will provide a progressive tax rate table, but not the person relief criteria. If we provide the person relief criteria, then what's the point of having exam, right? Okay. Let's move on to the next one. Okay, here is about taxations of employment income. Okay, part of this section is about taxations of employment income. Okay, employment income is taxed under section 10(1)(b) versus 10(1)(a) for trade income. So under 10(1)(b), employment is defined as gains or profit from employment, and section 10(2) actually further defines what gains or profit from employment. Okay, here you can see the common one: wages, salaries, leave pay, fee, commission, bonus, gratuity, perquisite. Okay, value of food, rent for or annual value for place of residence, sum sending to the account of any individual in the pension fund. Okay, then the section. Okay, these are the sections that relating to employment income. Section 10(6) and 10(B). 10(6) is about taxations of gains or profit from stock options. Okay, later on we'll cover how we tax stock option schemes. And 10(B) is about assess contribution to CPA designated provident fund. We also cover this later on. Okay, I just want to give you some sharing on the differences between employment and profession. Okay, because employment, just now although I say, okay, and gains or profit employment is defined, has a definitions like wages, salary, whatever. But in fact, there's no exact definition of what constitutes employment in the Income Tax Act. Okay, we only know that employment is taxed under section 10(1)(b), whereas income from profession is taxed under section 10(1)(a), which will be covered in the next module. because employment is not defined in income tax act, there are certain scenarios whereby a person can be working, but it may give rise to dispute as to whether this person's income is from exercising employment or is it carrying on a professions. Sometimes there are some ambiguity between the two. Say you can be working for somebody, but are you under employment contract or are you under a contract for service or whatever? So under case law, there are certain tests that you can help you to determine whether this is considered employment source or is it a trade source. Okay. I think the first test we'll see whether is there a master and servant relationship between the persons and the other person. Okay, if there is a master and servant relationship, then that should be an employment. Master and servant relationship refers to the employment has been the term employment actually has been described judicially as denoting something in the nature of a permanent positions. So employment will be there if there is a legal relationship of master and servant. Okay. Second test will be assistance of contract of service. The relationship between employer and employee actually is depending on the existence of this contract. It is different from contract for service. Either in Singapore under MOM regulations, if that person has the intention to employ you as an employee, they must have some certain contract. Okay, that contract will constitute an employment contract. Okay, versus contract for service for professional, that means self-employed persons. It can be just a verbal contract. Okay, it can be written or implied, so it's not so clear cut as compared to master and servant relationship. Okay, if you are under an employment contract, right, employer has a right to demand the service of the employee and direct the matter and method of the work to be done. Whereas if you are under a contract for service, usually the principal has no right to tell the contractor how to do the job. They will just have to tell you that hey, you have to complete the job by a certain time, but not exactly how you should conduct the job. Okay, what is the distinction between employment and professions? For the purpose of 10.6 is, or not for the purpose, section 10 is important. Here we give you a comparison between the two. Okay, contract of service and contract for service. Firstly, if you're under contract of service employment, you are not able to claim bad debts. There is no such thing as bad debts. Whatever employment income you earn will be taxable. Whereas if you are professional, you exercise a profession on your own, you may incur certain bad debts as if you cannot recover the payment from your client, then you may deduct under section 41A. The next one will be capital allowance. This is not applicable to employment. As you are studying in a corporate tax module, capital allowance is about the capital asset employed to carry on the business. Okay, for self-employed person, they may claim this under section 19. Next one will be the business expense. Okay, for employment, you know that if you have to incur some employment expenses like entertainment, whatever, usually that would be reimbursed by the employer because it's in the cost of the work they need to incur. So the amount, the type of expenses or the quantum expenses you can claim as an employee is very restrictive. Okay, whereas for self-employed persons, they can claim more types of expenses, business expenses, because I think self-employed persons are expected to incur these expenses on their own. Okay. Next one will be business loss. there's no business loss in the case of employment, whereas for self-employed person, they can claim business loss. They can carry forward and carry backward of the loss. The other thing is about the 60 days exemptions, as mentioned earlier. If they are non-resident employees, the employment income is tax exempt, whereas the 60 days exemption will not apply to self-employed person. Okay, if you're non-resident, come to Singapore, carry on a trade, right? We don't care how many days you're in Singapore, that trade income will be subject to tax. The tax rate, okay, tax rate between employment and professions. I think I mentioned earlier on, non-resident for employment in Singapore is taxed at 15% flat rate. For non-resident professional, I think withholding tax 15%. But certain non-resident professional, we tax their income. They can actually claim expenses, and the net income will be taxed at 22%. Okay, there's these options for them. Okay, source of employment income. Okay, when we want to tax a person's employment income, right, that employment income must be sourced in Singapore. Okay, we say we exempt foreign source income, so then we have to see, we have to know how to determine is it a Singapore source or not. Okay, Singapore actually adopts modified territorial basis of taxation, which means under this, under the charging sections of 10(1), tax is levied on income accruing or derived from Singapore. This is called Singapore source income, or income received in Singapore from outside Singapore. This is called foreign source income. But because of exemptions, actually we don't tax the second one. That is the foreign source income. That applicable to individual. Okay, I'm talking about individuals. So under section 10(1)(b) for employment income, income from employment accruing or derived from Singapore or received in Singapore is liable to tax. As I mentioned earlier, foreign source income is tax exempt. Okay. So the factors, we need some factors to determine is it a Singapore source income. Of course, most of the times, it's not difficult to determine the source on, because if you are under employment contract, you are employed to be exercising employment in Singapore, there's no doubt that this is Singapore source. Issue actually arise on those, sometimes in Singapore, sometimes outside Singapore, or you may be posted outside Singapore, or you may be actually based outside Singapore and you come to Singapore. Then difficulty arises in, is this part Singapore source or which part is not a Singapore source? So we need to have certain factors to determine the source of employment income. Generally, the factors that we look at would be like where the employment perform his services. Okay, where you perform services, this is a main factor. Secondly, would be the locations of the employer, where your employer is located. And thirdly is whose benefit the employer is performing the services. Okay, for example, an employee who is engaged by a Singapore employer to be based in Singapore, and he performs his services for the benefit of the Singapore company. So it's clear that his employment income in this instance is considered source in Singapore. This is notwithstanding, occasionally he may perform his services outside Singapore, especially when you are on business trip to overseas. It can be a few days, it can be for months, but this is still considered as Singapore source, right? Because that we will say that this will be incidental to your Singapore employment for the business trip like you go overseas. Okay, other than the above, we have two deeming sections under section 12. Will deem the person derive the employment income from Singapore. The first deeming section is 12.4. Section 12 is the dealing section. So you look at the provisions under 12 to see which are the type of income that we deem there in Singapore, arising from Singapore. 12.4 is about employer outside Singapore sends his employee to Singapore to perform services. So although he's not employed to be render services in Singapore, there are cases where the person actually working for overseas employer, but for business reasons, the employer may send the employee to Singapore to work. So under 12.4, that part income in relation to the services performed in Singapore is considered Singapore source. So we only tax that part of income attributable to the services rendered in Singapore as Singapore employment income. Okay, those rendered outside Singapore will not be Singapore source. The other dealing section is 12.5. 12.5 actually applicable to Singapore government servants who are posted to work outside Singapore, to posted to work overseas. Okay, 12.4 says that if you are a Singapore citizen or resident who are performing duties on behalf of the Singapore government overseas, is deemed to be Singapore source and is still subject to tax. You can be outside Singapore for years, but this is still a Singapore source employment income. Okay. Other than that, issue regarding source of employment income will be dual employment, as I mentioned earlier on, could be under a dual employment, as in part of your income, part of your employment is supposed to be for Singapore employer, part is for overseas employer. For this kind of scenario, we need to examine the employment contract to ascertain which part of employment is actually for Singapore employer, and then we only tax that part. That part that we determine to be for overseas employer, or is not supposed to be for Singapore's for exercising employment in Singapore, then we will not tax the other part. Okay, for this part we need to examine details of the employment contract to say to determine which part we should tax. Okay, okay, so far any question on employment source rule? Let me see what's the chat about. Is there any questions? Resident status, Chris, yeah, is for period, the confirmed period for YA 2022, because no, we are saying you stay until when that you can be assessed as a resident for YA 2022. So we are not saying, when you stay until March 2023, your income is assessed under YA 2022. We are just saying the person, if he stay until this date, whether we will assess the person as a resident for YA. So it's correct. The answer C is also correct. We're not saying that income for 2023 we want to assess in 2022. Okay. Will the personal relief amount be given? Announcement be, wow, you're very concerned about personal relief. Okay, not too worried about personal relief. Okay. Do we need to memorize the figures? What figures? You mean the amount of personal relief? We don't need to memorize. Do we have to quote relevant sections in exam questions? Maybe, but very rare. Okay, not too worried about that. Okay. Profession contract for service is applicable to self-employed individual, right? Yeah. Contract for service is for self-employed individual. Yes. Okay, let's move on. When is gains or profit from employment taxable? Income taxable under 10(1)(b). Basically, you look at two conditions must satisfy. Okay, it must be, as I explained, must be derived from any employment. Okay, that is, the employment must be the source of the payment. Okay, Secondly, it must be made with reference to the services rendered by the employee. Okay. By virtue of his office, meaning you hold the post to render the service, and is in the nature of a reward for the services rendered. Okay, so if you satisfy these two conditions, that income is assessed under 10(1)(b) as employment income. Example, if you could have derived income as a freelance food deliverer, okay, but as there's no master and servant relationship between you and platform operator, your income is not considered as employment. But it doesn't mean that that income is not taxable. You will be taxed under 10(1)(b) as a self-employed person. Okay, when determining the taxability of payment, we don't just look at the descriptions of the payment, right? Sometimes it could be quite misleading. Some employers or some employers label this payment as compensation for loss of office. We have to see what actually are the components of this lump sum payment in order to establish the true natures of this payment. Okay, for example, it's quite common. They may employer may include like payment in lieu of notice, gratuity, or other payments as under lump sum payment. So not all lump sum payments are capital in nature. Okay, you could have been retrenched or terminated employment by employer and a lump sum payment made to you, but it doesn't automatically become capital receipt and not taxable. So we'll have to look at what exactly behind this lump sum payment. See what are the components under this payment, and to see is this related to past, present, or future service. Anything that is relating to past services is taxable. It is the same for present and future. Future, we are referring to payment in lieu of notice. You're supposed to give 1 month notice, but you did not. Okay, and but the employer did not give you 1 month notice, and instead they pay you 1 month. Okay, this 1 month will still be taxable, right? The other is the reimbursement of expenses incurred by employee in the course of work. It's not perquisite from employment. Yeah. Okay, as defined on gains and profit from employment under Section 10(2)(a), it has to be arising from perquisite is something that is for reward for the services. So reimbursement is not. Okay, we go to the next slide to see the differences between reimbursement and allowance. Okay, reimbursement refers to an amount paid by the employer to the employee for expenses incurred by the person, right? Reimbursement expenses incurred by employee on behalf of the employer is not considered as gains or profit from employment. For example, where the employer reimburses the employee for airfare incurred for business trip, this is not a benefit to the employee, so that's why it's not taxable. It is not a perquisite, so to speak. But if let's say the employer happens to reimburse the employee for private expenses, it's still taxable. So it's not that all reimbursement are not taxable. Reimbursement must be business purpose. Then we say that it is not perquisite. But if the reimbursement for private expenses, such as your transport costs for traveling between office and home, or the employer subsidize you with rental, that these are all private benefits. So reimbursement will still be subject to tax. Difference between allowance. Allowance is a regular cash payment. Allowance, for tax purposes, allowance is taxable because the employer give you this fixed amount, and you actually do not need to account for how it's spent. So once it's a fixed allowance, it is taxable. The common allowance is housing allowance, traveling allowance, tax allowance, entertainment allowance. Strictly, all these are taxable. Of course, if you say you use some of the allowance for business purpose, example, you are provided with a fixed entertainment allowance on monthly basis, but in fact your job actually requires you to entertain clients. If you can keep records to say that, hey, part of this allowance actually expended for business purpose, then the expense can be offset against the allowance, right? But importantly is you have to keep proper records on that expenses, that business expense when you want to claim against your employment income. Okay, this table gives you a summary of taxability of some specific employment payments. Most of these items are taxable. Later on, we'll go through some common items on how they are being taxed. Okay, leave pay, all these are very common. Depends, contribution depends because there are certain specific treatments. BIK, benefits in kind, is because there are admin concessions for certain BIK, not exempt from tax. Okay. Okay, let's say leave pay. Leave pay actually is a salary paid for the duration where the employee goes on leave. Leave pay is taxable item, but the issue is the period of the YA that we should tax on. If the leave pay is for a period within the same calendar year, there's no difference whether it is regarded as accruing over a period of leave or as a lump sum, because either way, the same amount will be aggregated together with the remunerations and tax in the same YA. The difficulties is where the leave that straddles 2 calendar years. Then in this case, we may need to assess them based on the circumstances under which the leave pay is given. The first box says that where the lump sum is paid for future period of leave, then the leave pay is considered accruing evenly over the period of the leave. Amount of leave pay in relation to the period will be taxed in the respective YA. There's an example given there. Okay, this case is for future leave. Then we establish which portion is for 2020 and which portion is for 2021. Then we tax that portions in the respective YA accordingly. The second scenario is paid lump sum paid leave paid in lieu of leave entitlement. Okay, which is leave is commuted, unconsumed leave is commuted. Okay, in this case, you will tax the leave paid in the year when the unconsumed leave is commuted. So here you see the example is the accumulated unconsumed leave, 15 days from 2020 and 5 days from 2021, when the person was retrenched on 2026. Because it's commuted in 2021, the whole sum will be taxed in YA 2022. So it depends on whether it's paid for future leave or is it commutations of the unconsumed leave. Let's see what's this. Is it? Anything? Does anyone get echo on the audio? Is there echo on the audio? Okay, no. Some say no. Okay. No, I guess it's renovation. Sorry, it's not echo. There's some renovation work done outside. Okay, so sorry about that. I think they stopped the work. hopefully, yeah, okay. All right, yeah. You can hear me, right? Okay, next move on to
Sorry,
the,
Sule, since you're answering question, I think just now I just wanted to clarify. For the personal relief, so that means the amounts, if let's say there's a personal relief amount, that will be given if the question asks. Okay.
actually, okay lah, actually we don't, you know the question, okay, I will talk about the exam question later, after at the end of the course. I don't want to talk the exam now, so that I want everybody pay attention to this.
Okay,
I'll
can,
briefly
thank
tell
you.
you the format of the exam, and I'll give you some tips as in what you should focus on. Is that all right?
Yes, yes, okay, thank you.
All right, okay, let's move on to the bonus, okay? Bonus are payment that many of us looking forward to at the end of the year, right? So as an employee, you will definitely will receive certain bonus, especially the 13th-month bonus. Okay, there are different types of bonus, year-end bonus, performance bonus, incentive bonus, deferred bonus. Okay, taxing point, the issue is the taxing point, when we should tax the bonus, right? Then it depends on, okay, for tax purposes, we look at when this bonus, the employee legally entitled to the bonus, okay, legally entitled to it. So we look at it, if it is a contractual bonus, that means it's stated in the contract or in the bonus plan that the employer is supposed to pay bonus every year or whatever in the contract itself, then that bonus will be taxed according to the terms of the contract. Okay, typical example is the 13th-month bonus. Okay, 13th-month bonus will be in that calendar year. It can be paid in the following year, but because it's a contractual bonus, so we tax in the year that you are legally entitled to. Okay, conditional bonus is bonus that contingent upon conditions we met in future. Okay, condition bonus examples is more like inducement payment to the persons. It could be, it can be like a retention bonus as well. The employer usually will set certain conditions for you to receive the bonus. So for this type of bonus, taxation point will be when the conditions are met. Okay, say employer set a condition and say, hey, you must complete 2 years service in order to get this lump sum payment. So then when only after you have completed the 2 years service, that bonus is considered accrued to you after the 2 years, right? So we'll tax that when the conditions are met. But a lot of times, employer may pay you the conditional bonus upfront, okay, pay in advance to you before you satisfy the conditions. In this case, since it already paid to you, it will be taxed in the year of payment, although it is still a conditional bonus, right? The other is non-contractual discretionary bonus. These are the bonus that employer the bonus can be rescinded by employer anytime before actual payment. So you cannot take any legal actions against the employer even he fails to pay this bonus. It's not contractual, so it will be taxed in the year the bonus is paid. Oh, so we have another quiz again. Okay, when the bonus are taxable, then you launch a quiz. I think quite simple, straightforward. Okay, the first question, you can post your answer. Contractual bonus, 13 month, is payable for services provided in the year ended 31st December 2021. And it was paid in February 2022. So it should be taxing. Okay, I think everybody got it right. Okay, I'll end here. Okay, the next questions. Yeah, the answer is YA 2022. It's contractual. Okay, next one is specify in the okay, I will show all the 3 questions. Okay, Let's pull the second. Okay, I'll share the result. 100% got it right. This is straightforward. I launch the second questions. You post your question here. Okay. Okay. Also, okay, I'll post the question really. All right. Oh, 100%. Okay, good. Okay. Stop sharing. Yes. You got it right. Okay, it is specified under the bonus plan that the contractual bonus declared for the year ended 31st December 2020 will be paid on 2021. Okay, this is contractual bonus and is paid in 2021. It's taxable in YA 2022. Question 2, YA 2022, the answer. Question 3, employer informs his employee on 1st December 2021 of decision to pay non-contractual bonus on 1st Feb 2022. Okay, this is non-contractual. Of course, it's taxable when the payment is made, which is YA 2023. Right? So far, okay? Director's fee. Okay. Director's fees are fee paid to non-executive directors for attending the board meetings. Okay. Source of director's fee actually depends on where directorship is exercised when the meetings of the board of directors of company are normally held. Okay, director's fee are sourced in the country where the company is a resident. Okay, if you are the director of a resident company in Singapore, the board meeting could be held outside Singapore, but this is still considered as Singapore source director's fee. Director's fee is taxable in the year which the director is entitled to the fee. This will be usually the date of company's AGM, annual general meeting, or when the director's fee is approved by the board of directors. So there are two scenarios. One could be approved in arrears. The other one is approved in advance. Okay, if it's approved in arrears means director already rendered the services, it's just that AGM held a year later. Then we will tax when it is voted and approved at the AGM. Okay, the year when it has been approved. For director's fee that approved in advance means, oh, the director have not rendered the service, but the board meeting actually or the AGM approved that this director entitled to a sum of director's fee. Then we don't go by the year approval because director have not rendered the service. So that payment, that sum will only be taxed when director has exercised or rendered his services. Right. These are the tax treatments of director's fee. Okay, quite straightforward. Okay, let's see what's the question about. Oh, what can a person do if a tax bonus is subsequently called back? Okay, if it's called back, I think I'm not sure. Is it a conditional bonus? If it's a conditional bonus, yes, we tax based on year of payment. If it's called back, the employee can provide evidence, okay, documents to IRS to say that it has been called back because he did not satisfy the conditions. Then we will allow that we will allow that amount called back in the year when it has been called back against the employment income. Right. The next question can be approved through AGM. Not sure. Are you talking about director's fee? The director's fee will be approved in the approved in the annual general meeting. Should be approved into annual general meeting. Okay, let's move on to benefits in kind. Oh, yeah, yeah. Oh, if they have an EGM, you mean other than AGM, there's the EGM, extra general meeting. Oh, it can be considered as a general meeting as long as it's approved. Yeah, some companies may have more than, may have EGM. Yeah, so long it has been approved. Okay, benefits in kind. Other than normal salary bonus allowance, it's quite common for employer to pay BIK or benefits in kind as additional perks to attract and retain employees. I believe most of the employer will provide BIK in one form or another. As I explained earlier on, all gains or profits from employment are taxable unless they are specifically exempt from tax or are covered under the admin concessions. Benefits in kind, okay, if you're talking about tax treatment, strictly all are taxable. But issue may be because some benefits in kind the value could be very small, very low. And it's difficult for employer to track the value of the benefits. So because of these reasons, and to actually reduce the compliance cost, IRS has actually granted certain admin concessions for various case. Okay, this slide actually show you the benefits in kind that are covered under the admin concession, which is not taxable. Actually, there are certain objectives. The BIK must meet certain objectives in order to be granted admin concession. The first categories is those benefits in kind that foster goodwill or promote camaraderie among staff. This is actually to encourage desired social behavior, right? So BIK that meets these objectives are exempt from tax. Okay, you see some of the example like sponsor group outings, but exclude subsidized holiday trips, family days event. Sometimes you can find it's very difficult to attribute a value to an employee. Corporate dinner and dance, social recreation facilities, corporate tees, marks, t-shirts, all these are covered under the admin concessions. The other category is relating to employees' health, medical benefits. Okay, it is not taxable. All the reimbursement of the medical benefits are not taxable, including dental hospitalizations. Okay, I will just briefly go through some benefits in kind, the treatments of benefits in kind. Here is the insurance premium paid by employer. Okay, actually, if it's a personal insurance policy, the premium paid by employer is taxable in the hands of the employee. This is obviously perquisite to the employee because he doesn't need to incur premium and get the policy insurance coverage. So this premium is taxable. Group insurance policy, there are some admin concessions. Okay, if it's group medical insurance policy, the premium is not taxable in the hands of the employee. But they have to satisfy that this benefit is available to all staff. Group insurance policy where employees are entitled to pay out contractually. It's a bit tricky here. Okay, meaning okay, although it's a group insurance policy, right? In the policy contract, it says that the beneficiary is the employees. Okay, whatever happens to the employee, employer has no right; it has to pay to the employee. Then for this type of group insurance policy, this group insurance policy, the premium will be taxable in the hands of the employee. This group insurance policy are like critical illness, accident, personal accidents, life insurance policy. Okay, not the medical insurance policy. The other group insurance policy where employees are not entitled to pay out, meaning okay, employer actually get a group insurance policy to cover all employees. If there's something happen to the employee, the policy holder is the employer get paid out. And employer has a right to say whether I want to pay to employees or not. Okay, in this case, the premiums are not taxable in the hands of the employee. If the employer subsequently disperse a payout to the employee, then the payout will be taxable in the hands of the employee. But if it's a death, gratuity, compensation for death or injuries, that is specifically exempt of tax. Okay, air passage usually provided to expatriate foreign employees from year assessment 2018 onwards. Only passage benefits are taxable, except for commencement of employment in Singapore and upon termination of employment. Okay, if this for expatriate come to Singapore and the employer provide the air passage for him and his family to take up employment in Singapore under any concession, this is not taxable. Similarly, if he has completed employment contract and returned to his home country, that leave passage or the air passage provided employer is not taxable under the admin concession. Other than that, all taxable. Okay, in between, if the employer provide him to return home for holiday, this is taxable benefits. Okay, accommodation is also a benefits that usually provide to foreign employees. I think for accommodation, I think you just have to memorize how we tax accommodations. We look at whether the property is it rented by employer or is it owned by employer. The difference is whether is it rented by employer or is it owned by employer. Okay, for property that is rented by employer is very straightforward. The taxable value is the amount of rent paid by the employer. The amount of rent will include rent for furniture and fittings paid by employer. If the employer also wants the employees to pay some for that or to share the rental, then we less out the amount of rent paid by the employee to arrive at the taxable value. So if the property is not rented by employer, so an employer didn't incur any rental, the rent to provide that property to the employee, then we look at the annual value of the property. Okay, there will be annual value available. I think it's under the property evaluation fees can be determined what's the annual value. Then we tax based on annual value. If the employer also collects some rent from the employee, then we less out the rent paid by the employee to arrive at the taxable value. For furniture and fittings, right, if it's rented by employer, of course, will be the value of the rent paid by the employer. Okay, if it is a property owned by the employer, then you look at, hey, is this a partially furnished property or is it a fully furnished property? Partially furnished is only very basic fittings provided in the premises. So usually most of the cases they consider as fully furnished. So fully furnished, you take 50% of the annual value to arrive at the value of furniture and fittings. So when you compute the taxable value of accommodation, you take the annual value of the property plus another 50% of the annual value to arrive at the total taxable value of the accommodation. Of course, if the accommodation to premises is not provided to employee for the whole year, then you have to apportion. If it's 9 months, then you take 9 months. Okay, 9 divided by 12 to compute the taxable value. And hotel accommodation, if hotel accommodation is provided, then it will be the actual cost incurred by the employer for the hotel stay. Okay. If the employee also have to pay some, then you less out the amount paid by the employee. Okay, share options. Okay, share options, right? Share options is benefits given to employees, especially by MNC. But a lot of startup company also provide share options or share benefits to employees. Sorry, this is about BIK, not share options yet. Okay, I actually have gone to another slide. Okay, BIK of CPA pension provident funds. Okay, the treatments is under section 10B, capital B. 10B deems a contribution to CPF by employer in excess of mandatory contributions as income. Because the excess CPF contributions or voluntary contribution by employer is a benefit to the employer. Under CPF rule, if you are not required this sum and you and the employer contribute for you, this will be a taxable employment income, right? The other category is obligatory contribution to non-obligatory contribution made by employer to any overseas pension fund. This contribution is taxable in the year when the contribution is made. This is not considered as mandatory contributions because certain companies, overseas companies, when they have employers sent to Singapore to work, they continue to contribute the CPF for his home country's provident fund. For tax purposes, the contribution made in each year will be brought to tax. Okay. Obligatory contribution to CPF without mandatory limit, within mandatory limit. This is for your info. From 1st Jan 2016 onwards, the mandatory contribution for monthly ordinary wages is capped at 6,000. Overall cap is 102,000. Let's see what's this. Okay, I want to see what's the question. Is the compulsory CPF contribution rate table provided in exam? No, it's not provided in the exam. Okay, share options. Okay, next few slides will cover taxation of share benefits granted by employer. Generally, there are two types of employee share plans. First one is the employee stock options, ESOP. And the second one is the employee share ownership, ESOP, ESOW. Okay. Employee will be taxed on the gains if the shares are granted in respect of Singapore employment. Okay, the tax treatment from 1st Jan 2003 onwards. A person, an individual employee who are granted share options or share ownership when he is working in Singapore, these share gains will be subject to tax in Singapore. It is regardless of where the person exercised these options. Okay, he could have exercised after he left Singapore, or the share awards could have been vested to him after he left Singapore. But as long as the ESOP granted to them when they are working in Singapore, that share gains will be subject to tax under 10(1)(b). Okay, how to determine when individual is taxed? It's the same tax where employment income criteria as well as employment source rule. Remember that earlier on I talked about employment source rule. You have to use the factor to see is it a Singapore, whether the person is actually exercising a Singapore employment. So if it's exercising a Singapore employment, all the employment income will be subject to tax. So when the shares are granted, when the person exercising a Singapore employment, that share gains benefits will be subject to tax in Singapore. Okay, there are some key terms relating to the tax treatment of share gains, you need to know. Okay, here the tables give you the vesting period, exercise price, moratorium period. These key terms are usually found in the ESOP or ESOP plans. Okay, vesting period actually refers to a period when the employees are required to fulfill the prescribed condition before the employee is allowed to exercise the share awards or to acquire the share awards. Exercise period is when share options actually vested on you, and then employer give you another period of time for you to exercise the options. Okay, once the period is lapsed, right, the employer would have no right to exercise anymore. And a period is given is because employer can wait until, because when you exercise the option, you may require to pay some exercise price, or maybe the share price is not to your benefit, so you may hold on for a while and not to exercise. So as long as exercise within the period, right, then you will be able to acquire the shares. Exercise price, as I earlier mentioned, is paid by employer to acquire the shares when he exercises the options. Moratorium period is when the period the individual is not allowed to sell the shares after the share options are exercised or vested. Okay, I'll give you that diagram to show you the timelines. Right? So look at this. The first one is no selling restrictions, meaning no moratorium, selling moratorium. So the timelines will be from grant date to vesting date or exercise date, and then date of sale of the share. This is we for tax purposes we only look at grant date, vesting date, exercise date. Okay, date of sale has got no tax implications. Right. Next one would be the one with moratorium. Selling restrictions. Okay, the only difference between the two is that here there is another milestone. That is the moratorium period. After you exercise or after vested the shares on you, you cannot sell within that period. So for tax purposes, that moratorium lifted date will be taken into account to determine the tax payable or to determine the taxable value. Again, we don't look at the date of sale of the shares by the employee. Computations. Okay, computations without selling restrictions. The table gives you an overview how we determine the taxable gains. So in this case, where there is no selling restrictions, the taxing point is as soon as the options are exercised or the shares are vested on the person. The gains will be computed based on the open market price of the shares on these dates, less the price paid by the employee on the shares. Okay, these dates are listed there: date of exercise, date of vesting, date of grant. Okay, sometimes employer may not impose the vesting period. They will just give the shares to the employee straight away. As long when you grant, it is immediately vested on the person. If that's the case, then the date of grant, the open market price of the share on date of grant will be used to determine the taxable gain. At this point, employee may or may not have sold the share. If he sells the shares at a later date or several years later, the proceeds from the transaction is capital in nature and not taxable. This one is where there is a selling restrictions. Okay, where there is a selling restriction, the taxing point is on the date when the selling restriction is lifted, regardless of when he disposed of the shares. Okay, the share gain is computed based on open market price on this date less the price paid by the employee. The subsequent realizations of gains is that has no tax implications. Okay, we will have another quiz again. Computation. Okay. Okay, let me launch this. You can work out. Okay, you can work out the share options, the taxable gains now. Okay, and you pose the questions. Okay, let's see. Share in exercise, share options. Share option granted on 1st March 2018. Exercise price $5. Number of option granted 5,000. There is a moratorium period imposed. What is the amount of taxable ESOP gains? Wow. Very good. All of you got the right answer. Okay. It's 10,000. Yes, yes. Everyone know how to get 10,000, right? 10,000. Huh? Okay, 10,000. 10,000 is using $7 minus $5 times 5,000. Okay, this one straightforward. Okay, let's move on to the next one. Deemed exercise rule and tracking options. You know that for share awards, generally exercisable or vested a few years later after the grant. So there are foreign employees who are granted the shares award when they're in Singapore, when they're working in Singapore, but the shares has not been vested on them. And under the tax rule, we say that we only tax an employee when the shares are vested or exercised. So what happens if they leave Singapore and yet the share has not been exercised or granted? There will be revenue concern because once the employee leaves Singapore, we cannot tax the person. We may not be able to recover the tax on the person, and we don't know when the share options will be exercised or vested. So to address this issue, we have this deemed exercise rule under section 10(7), right? Under these sections, under this rule, the unexercised ESOP or the unvested ESOP are treated as if they have been exercised or vested 1 month before the employee leaves Singapore. Okay, so when the employer file tax clearance for this employee, right, the foreign employee leaving Singapore, the employers are required to file tax clearance 1 month before the employee leaving Singapore. So at the point of time, the employer had to determine what is the deemed gains of these unvested options or unvested share awards. Then file and report the gains for IRAS to tax the sum. Okay, this is called deemed exercise rule. The other one is a tracking option. Tracking option is an alternative to deemed exercise rule. Some employers do not want the employees to be taxed deemed gain because they have not derived the gains yet. So they will apply for tracking options. Under these tracking options, right, the employers are allowed to track when the income realizations event of the employee occurs and report the gains to CIT. That event means when the options are exercised or when they are vested, employer have to report the gains to IRAS. Then employer also have to undertake to collect and pay the tax on the gains to CIT. There are several requirements for employer to comply with before they can apply for the tracking options. Not too worried about tracking option, it's not examinable, it's just for info. Okay. Okay, let's have another quiz on deemed exercise rule. Okay, you can work out the answer for A and B. Now, I will launch a poll. Oh. Oh, okay. I don't have the poll for the A, for the question A. I only have the poll for question B. Okay. Never mind. Then you just pull your answer for question B. At the same time, you can also work out what's the taxable value for question A. The difference between the two, right? Question A is share option granted before the employee leaving Singapore, or way before he leaves Singapore. Question B is within the 1 month, okay, after within the 1 month of tax clearance period. So for question B, I think okay, most of you have posed answer for question B. Okay, for question A, right? The answer is give you the answer because I don't have the poll for question for A. 25,000, right? You know how to arrive at 25,000, right? Okay. This question is, he was granted a visa on 1st September 2020, and employer sought tax clearance for him on 2nd September 2021. As I mentioned earlier, for tax clearance, right, you had to take the open market price of the share 1 month before the tax clearance. So in this case, will be the price on 30th August 2021. That is $1.50 minus the exercise price of $1. So the gain is 50 cents multiplied by 50,000 shares. And then the answer is 25,000. Okay, for the second question, okay, most of you got it right. Some of you got it wrong. Okay, I share the result. Okay, the answer is 22,500. How do we get the 22,500? So that, okay, I want to show you 22,500. How do we get the 22,500? You see that the ESOP was granted to him on 15th September. That is within the 1 month period of tax clearance. So we have to take the price on 15th September, which is $1.45 minus $1 exercise price. So it's 45 cents. 45 cents multiplied by 50,000. This will give you 22,500. Okay, let's move on to the next one. Next up. Okay, let's move on to some employment expenses, the deductibility of employment expenses. As I earlier mentioned that for employee, right, the employment expenses are quite restrictive. This is because most of employers are likely to reimburse the employee for the expenses he incurred in the discharge of his duties. So below are some of the common claim for expenses, deductions or expenses against employment income. The deductibility will depend on the satisfaction of Section 14(1) and not prohibited under Section 15 of the Income Tax Act. So it must be wholly exclusively incurred in production of income, and it must not be capital, personal, domestic in nature. Okay, and mind this principle. So taking into account of this tax principle, first one, traveling between office and client's office or meeting place. Okay, this satisfies Section 41. It's for business purpose. It's not domestic and personal. So this is deductible. Okay. Next, entertainment incurred in production of income and not primarily social or private in nature. Okay, it qualify. This is for business and it's production of income and it's not personal in nature. So this is also deductible. Entrance fee for professional bodies. Okay, if you are a professional, say you're accountant, you actually join a professional body, a CTP or whatever, to become a member and to gain or apply the knowledge in performing your duties as an accountant. The subscription fee, the next one, subscription fee paid to professional bodies is deductible. Okay? Whereas the entrance fee paid is capital in nature. This is one time. Entrance fee is capital in nature, is not deductible. Subscription fee is deductible. Employment expenses incurred in obtaining employment, not deductible, right? It's capital in nature. This is before you actually commence employment. It's for you to gain a source of employment. It is not something that you incur in the production of income. So the last one is not deductible. So here is just give you a general deduction rules for employment expenses. Okay, next, I will just briefly touch on other income that a person, an individual may derive. Other than employment, which is the main source of most individuals, some individuals may have income from dividend, interest, discount, which is tax under 10(1)(d). Right? In dividends, everybody, I think you all would know dividends actually refer to the share dividends. Interest is either from bank or from deposit or from any bonds or whatever. Discount actually is amount paid less than face value of the financial products. Like now very common is the T-bills, treasury bills, or certain government bonds or bonds, any bonds, that securities where it can be redeemed after a short period of time. Okay, that discount given is considered income under Section 10(1)(d). Section 10(1)(e) is pension charge annuity. Pension, as I mentioned earlier, pension is like the employer can pay you pension when you retired. Pension, only government pension is tax exempt. Other than that, most of pensions are taxable. Charge, actually, charge is referring to payment made under court order. In the past, we have this so-called, payment made by ex-husband to the spouse under court order for maintenance of the ex-wife. This payment is taxable under charge 10(1)(e). Annuity, the charge is an annually maintenance payment received under a court order. Annuity is like product, insurance product, you may receive payout from that insurance product entity. Okay, about that charge and I want to say about alimony and retainers. Okay, actually there's a change in the tax from 2011. Okay, any alimony paid by ex-husband to the spouse, to the wife, is not taxable. It's tax exempt. It's no longer taxable. Other payment from trust, okay, under 10(1)(e), right? Payment from trust settlements will be taxed under 10(1)(e) as well. Okay. 10(1)(f) is for royalties. Royalties are payment for the use of the right copyrights, scientific works, like patents, trademark, designs, license. Okay, all these payments are taxed under royalty. The other common items under individual tax is the rent paid for property that are rented out. Rents premium. Premium from properties actually refers to like a key money, a person who wishes to occupy a property and then he paid a key money or under table money to the owner for him to vacate the property, then that is also considered a profit arising from the property and taxable under 10(1)(f). 10(1)(g) is for any income that not falls under 10(1)(a) to 10(1)(f). It is income in nature. It's a profits or gains or employment nature. It is a catch-all section. So whatever is not, if it's an income and it's not taxed, it cannot be classified under 10(1)(a) to 10(1)(f). It still can be taxed under 10(1)(g). Later on, a typical example that we tax under 10(1)(g) is the supplementary retirement scheme payout. Okay, we'll cover the SRS later. Okay, let's move on to the next slide. Yeah, SRS. Okay, I just want to briefly go through this SRS scheme with you because there are very few tax schemes that are available to individuals. So I think it's worthwhile to just cover SRS. This is a voluntary scheme that helps individuals to save for retirement. For those who need another saving scheme to complement CPF, SRS is optional. Okay, anybody can join, and it also opens to foreigners. Okay, it's operated by 3 major banks: DBS, UOB, and OCBC. The scheme also helps foreigners to save for their retirement. Okay, what else? Okay, contribution. Once you make the contribution, you open an account with the banks, that the contribution can be used for various investments. Okay, of course, because the contribution is tax deductible under relief, 50% of the withdrawal from the SRS at retirement age are taxable. Okay, tax relief for SRS. Okay, for Singaporeans or SPR, the maximum contribution a person can make is 15,300, whereas for foreigners is 35,700. It's higher than Singaporean and SPR because Singaporean and SPR has got CPF contribution. So this is just to complement their CPF. So the amount of contribution is kept at a lower amount, whereas for foreigners there is no CPF, so that's why the contribution is higher. Okay, as withdrawal, okay, taxations of withdrawals of SRS, as relief is given, of course, the withdrawal is taxable. Okay, withdrawal inclusive of contributions as well as a investment return. Okay, whatever you in your SRS account, the funds remain in your SRS account when you withdraw, right? 50% is subject to tax. That 50% applies to withdrawal on or after prescribed retirement age. So if you had opened the account that time when the prescribed retirement age is 62, so when you withdraw upon you reach 62, then that every time when you withdraw, the 50% will be subject to tax. The other forms of withdrawals, that is 50% is subject withdrawal, is a form of annuities or those who early retirement but due to medical ground. Then 50% is also taxable. For foreigner, okay, they have to satisfy the condition in order for the tax treatment of 50% to be applied. That foreigner must be maintain the SRS account for at least 10 years from the date of their first contribution. And they must not be Singapore citizens for a continuous period of 10 years. So if they satisfy this condition, they can withdraw the whole lump sum, but only 50% will be subject to tax. For other scenario of withdrawal, 100% is taxable. Okay, like the bankruptcy or early withdrawal before retirement age. Early withdrawal before retirement age is also subject to 5% penalty. Okay, once a person starts to withdraw the funds from the SRS account or upon the statutory retirement age, there is a 10-year withdrawal period. Start from the date of first withdrawal. Any remaining sum will begin to be withdrawn immediately after the end of the period. Under our current tax rule, the tax structure, because we have 20,000 tax exemptions on the first 20,000 chargeable income. That's why there is this so-called 40,000 tax exempt period. Assuming if you have 40,000 in your SRS account when you reach 62 years old, you can have 10 years to withdraw this 40,000. So if you withdraw 40,000 every year, right? So only 20,000 will be taxable. And the first 20,000 is tax exempt. Basically, you are non-tax for that withdrawal. This is how the 400,000 is arrived at. Okay. The next few slides is on how you apply the withdrawals or upon death or whatever. Not to worry, I will not go through because of the time constraint. The few slides about SRS withdrawal, how you compute the taxable amount. Not to worry about how to compute. It's not examinable, but it's good for you to learn how this is computed. Okay, taxable sum. Okay, I would like to move on to locally sourced investment income, the tax exemptions. Okay, earlier on I touched on section 10(1)(d), the taxable other income. Remember the share dividends, the interest, the pensions, whatever, at discount. Okay, all these strictly under the law, they are taxable income. But there is this exemption scheme introduced in, if I'm not wrong, I think it's 2004 to encourage locals to invest their income, invest their funds into investment. So this slide actually gives you an overview of exemptions for investment income. These include, okay, the common one like bank interest. Okay, bank interest from deposit with approved banks is exempt. Okay, dividend paid by company, Singapore company is exempt. Income from structured product offered by financial institutions also tax exempt. Unit trust, all these are payment from life insurance policy also tax exempt. Debt securities, annuities. Okay, all these are tax exempt. So if exam questions, there are questions asking, okay, give you certain investment income, then you look at, is there a locally investment income? If so, is this covered under the tax exemption under section 13? Then you don't need to bring this to your tax computation. Personal release.
What if the company is what if the individual is an sort of like a investor by profession?
Oh, okay. The exemption will not apply to those who carry on the trade. If he's carrying on a trade of investment, basically you have to set up a company. I think either set up a business to carry on the trade. If so, then this exemption will not apply.
I see. Thanks.
Okay, yeah, it's a question of fact whether the person actually carrying on the trade or not. Right? Generally, individual who have the investment in this will be covered under the exemptions. Okay, personal reliefs are available to resident individual taxpayer under Section 39. Currently, there are 15 types of reliefs, including CPF and SRS. There are specific conditions tied to each type of relief. Example, income conditions, age conditions, marital status. Just bear in mind from YA 2018 onwards, there are a total cap of 80,000 for each individuals for the release claim. Okay, next is a parenthood tax rebate. This rebate is available to an individual resident in Singapore who is married, divorced, or widowed and has children born or adopted on or after 1st January 2008. Its objective is actually to encourage couples to have more children. Quantum of rebate depends on order of the eligible child. So you can see from the table, first child is 5,000, second is 10,000, and third and subsequent child will be 20,000. Okay, you don't need to memorize this. This is not examinable. Okay, good news. Okay, okay, this one is to give you not overview, it's just to give you to see how tax computation it look like. Okay, typical tax computation of resident individual sources of income aggregated together. You can see employment, other income aggregated to become statutory income. If there's any donation, we less out donation to arrive at the assessable income. Other assessable income, we less out whatever personal reliefs and resident individual is entitled to. Thereafter will be your chargeable income. From chargeable income, you use the tax rate provided in Part A, the second schedule of the ITA, to compute the tax payable. Then you less out whatever tax rebate is available or eligible to that taxpayer is eligible to arrive at the final tax payable. Okay, in exam, right? For this part, for this employment income, this question part A, we will just stop at assessable income. Okay, good news again. You don't need to compute this part. Okay. Okay, not much time for the case study. It's a straightforward case study. I will not provide you answers in physical form, or I will not upload to the text, the portal or whatever, because this is actually meant for those who come to attend the webinar. I want them to learn from this. So I may not have time to go through each, but this is a simple questions. It's actually a foreigner who exercise employment in Singapore for less than a year. So in this example, you have to work out what is his taxable income for that year. Okay, the period is from 1st January 2021 to 30th November 2021. So in this example, you have to indicate taxable amount. Okay, because of the interest of time, I will just show you the answer here. Okay. Monthly salary 12,000, because 11 months, he times 11 months to get 137,500. Discretionary bonus for the year 2020 paid on this date, 1,005 is taxable. Airfare for him to return home upon completion of assignment is not taxable under any concessions. Partially furnished apartment. Here, remember, partially is 40%. So worked out to be 34,650. Okay, okay, this share options, the taxable value is 8,200. Premium for group insurance, medical insurance is not taxable. Transport allowance is 2,000 per month, 11 months will be 2,003. And staff discount, $200 is taxable. Contribution by his employer to his pension fund in Australia, taxable. contribution by his employer to his SRS account is taxable. And then the rest of other income mostly are tax exempt. Okay, all are tax exempt except for interest from loan to a colleague, 2004. This is not covered under section 13. Okay, this is the final slide that I want to show you is how you compute those who need some mathematical computations. Give you some time, and maybe you want to take a photo of this. You will not be given to you, but here for those for the benefits of those attending the webinar, you may want to copy how you compute this taxable sum. Anybody have any questions on that so far?
Hi, Sule. Do
Hey,
you
hi.
mind flashing the previous slide again? I missed it.
Which slide?
The one with the other income and remittance from overseas.
This one?
Yeah, thank you. Okay, got it. Thank you.
Anyone else miss out any answers?
Sorry, Shide, so for the interest from his saving bank account with Westpac is also not taxable, is it?
Yeah. This is foreign source income, right? Remember you say foreign source income is not taxable. Any other questions? Okay, if no questions, I will just okay, I sum up. Okay, what I shared today is the general tax principle of individuals. Okay, importantly, you must know how to apply residence tax, okay, to an individual because it affects the tax liability of the person. Okay, secondly is we must determine the source of the income, source of the employment income. Okay, only source from Singapore is taxable, right? Because we are adopting territorial basis of taxations. Thirdly is the taxations of employment income, right? The taxing point, okay, when is it tax entitled to accrue to the person to tax? The other one will be the deductibility of employment expenses. As I mentioned, it's very restrictive. As we satisfy the section 14 deduction rules and not prohibited. Okay, just bear in mind this principle when you determine the deductibility of a particular type of expenses. The other one, okay, I think share gains, that part of employment income, you must know how to compute the share gains. Okay, that is important. Other income, you basically I mentioned most of the other income is tax exempt, right? Personal relief. The exact question actually, because we only have 10% for this question, so we can't test you a lot of things, you see. So most of the time it's about taxability of the employment income. We don't tax on, okay, this is another tips. Personal reliefs will not be in the question. So don't worry about personal relief and parenthood tax relief. Any more questions? I think that's about all from me. Because it's 11. We need another 10 minutes break for Li Ying to come in to share with you from ourselves on top. Will the question asked in the exam be short question answer, or are we required to do the tax com for an individual? As I mentioned earlier, the tax com is only up to assessable income. Okay, you will be asked to determine the taxability of each type of income. What is the total ESOP gains on slide 35? Slide 35. Oh, I thought I showed the slide 35. Slide 35. This one. Okay, 22,500 and 25,500. What is total gain on slide 35? Okay, then for case study question 3, where can we get the 350 times 11? What's the 350 times 11?
Shulei,
Yes.
the slide 35, right? The total deemed ESOP gain, that one is the 25,000 plus 22,500, is it?
Slide 35, slide 35. You're looking at A or B?
I'm talking about the below one.
Below means this one.
Last item, total deemed.
The B, right? If he was granted ESOP on 15 September 21, right? B, right?
Not this one, it's the last item, last line item. Total deemed ESOP gain.
Oh, okay. No, this one, no answer, because I provided an answer under A and B here. Can you see the answer here?
Correct.
The
So that one
25, 25 and 22. Yeah. So this one, no answer for this.
Okay, sure, thank you.
Okay. Yeah. And yes. For case study question 3, where can we get the 350? 350. Where got 350? 350 times 11. Which item you're referring to? AB minus 350 times 11. Assume that is.
It's in the next slide.
Zero times 11. Annual
Next.
value. Oh, next one, right? This one? Oh, okay. Remember furniture and fittings? Taxable value. Oh, this 350 is the rental paid by the employee. Partially furnished apartment provider employer, area of the premises is 350. Oh, okay, I didn't specify. Okay. The employees are required to pay a rental of 350. Yeah, I didn't specify here. Let's see. Okay, assuming employee have to pay a rental of 350. Yep. Okay, forgot to please info. Okay, 350 is a rental paid by employee for the 11 months. Is that okay? Just to check. Which one? 36 again. 36 again. Oh, okay. I repeat. Okay, first one, deductible. Second one, entertainment deductible. Entrance fee not deductible. Subscription fee deductible. Expenses incurred in obtaining employment is not deductible. A mistake. Okay, it's supposed to be 1,400, not 400. I missed out one. Thank you for finding out. It's 1,400 taxable sum, interest from loan to colleagues, 1,400. Okay, I will end the session here so that not get overrun by VA. Okay, thank you. You still can send your question to TA to me if you would like to clarify certain things. Okay, let's have a 10 minutes break now. Thank you. Farida, you would like to put on the clock for 10 minutes? Farida, are you putting on the clock 10 minutes break?
Hello, can you all hear me?
Yes.
Okay, very good. I will start in 1 more minute, just 1 more minute to 11:20. So I will start in a minute's time. Okay, it's 11:20 already. Hello, yeah, good afternoon, everyone. Welcome back to the second session of the training. And this second session will be on module 5, I think. Yes, module 5. Next, module 4, sorry. Okay, which is on the sole proprietorship. Okay, before I start, just a quick introduction of myself. Okay, I am Li Eng. I am the Assistant Director of Small Business Division in IRAS. And the branch that I'm in is the Business Operations branch. And what happened is that in this Business Operation branch, we administer the income tax assessment matters for small businesses. Small businesses will include the sole proprietors, partners, and partnership. Okay, so in today's course, I will be sharing with you the tax treatment and rules applicable to a self-employed person. Basically, I think you're aware already after attending Siulei's course that a self-employed person is actually different from an employee. Okay, a self-employed person is an individual who earns a living by carrying on trade, business, profession, or vocation. So usually the self-employed person is a sole proprietor or a partner in a partnership. Okay, thereafter I'll touch on the certain tax principles like deductibility, non-deductibility of expenses. Okay, I think you all should have covered the corporate tax module, right? Where there are some topics on this expense deduction. Basically, it's the same section as what Siulei also mentioned. We are governed by section 14 and section 15. So for the purpose of this, this module, I will be touching more on the expenses that are more relevant to a sole proprietor. Okay, and I'll also be touching on relief, MediSave CPA relief, and what happens if the sole proprietor has losses. Okay, so far we are talking about profits where we tax. Okay, what happened that there are losses or CA allowances? How do we treat them? Okay, so we have this carry forward, the losses, or the carry back relief system. And at the same time, also we'll be touching on partnership structures. That is the general partnership, the limited liability partnership, which is the LLP, and the limited partnership LP. Okay, last of all, okay, I will explain certain concept, which is very important, how we allocate partnership income, especially for LLP. We'll be looking at the relevant deduction restriction, which is really critical, in computing the assessable income of the partners of the LLP. So do pay more attention when we go through the example or the illustration, so you have a better understanding of the topic. And after that, we have 2 case studies. Okay, I tend to commit maybe the first 1 hour, okay, the first 1 hour to the slides, which is around 50 slides. Okay, thereafter, we will have a short break. And when we come back, I will touch on the 2 case studies. Okay, for the 2 case studies, I would prefer more active participation. Okay, the first session, the 10 over slides is more like a lecture. Okay, but when it comes to the case studies, if possible, I would appreciate if we get some volunteers, and we go through together, we fit in the answers, and then from there we learn properly. Okay, okay. There is already a question posed. Okay, okay. I'll be going through the 50 slides. Okay, so I would most probably be teaching you all, through the slides, and if there are any questions, I will take the questions after the 50 slides. Okay, after this deck of slides. That is before we have a short break before we go on to the case studies. Okay, since there's one question that's posted. Okay, the question is, if a person employed by a private limited company which is wholly owned by him, is the person considered a self-employed person? Okay, private limited company is a separate legal entity. So if the person is employed, okay, we're talking about director even. Director of a private limited company, they are considered as employee. They may be owner in that sense of a private limited company, but they are actually considered as employee and not self-employed person. Okay, so I hope I answer your question. We will move on, but before I move on, from the question that was being asked, it seems that you are quite concerned with the exam. Okay, I just want to I know you all may be quite tired now after the first session, but hope you can bear with me, for the next 2 hours. Pay more attention to the slides that I am teaching you, especially on the case studies. The case studies are very useful and important. Okay, so for the slides that I go through, there may be certain topics. If I mention, it's important, it is expected that you know. And yeah, pay more attention to it. And I think you shouldn't have problem doing the exam questions. Okay, Ken? Okay, so as I said, I will move on. Sorry, I tend to speak a bit fast. So if I speak too fast and you all cannot catch what I'm saying, please alert me. Then I'll try to slow down. Okay, Ken? Thank you. Okay, so now we will start. Okay, so proprietorship. Okay, so proprietorship is actually a business. Okay, so for taxation, we don't tax the business, we tax the owner. Okay, the owner is a sole proprietor. Okay, the sole proprietor is a person who owns and operates a business, and usually this business will have registered with ACRA. Okay, so a self-employed person is one who carries on trade, business, profession, or vocation. And the income that this self-employed person is getting is actually accessible under 10(1)(a) source income, versus earlier on where Sule taught you all, the income is accessible under 10(1)(b) because they are employee, employment income. Okay. So for this session, we are talking about 10(1)(a) source, that means self-employed income. So earlier on, Sylvia also touched on how you differentiate a self-employed person from an employee. Okay, the gist of it is that when we look at the person, okay, basically he's a self-employed person if he works independently on his own. He is like a boss himself. If he opens a business, he operates a business, okay, he's the owner of the business. The profits of the business is actually his profits. Okay, so he's in a position to realize profits, and we do have self-employed person who are actually like carry on vocation. Okay, when you say they carry on vocation, we are referring that basically they're on their own working, like commission agent, like PHC drivers. Okay, so they are also classified under self-employed person. Okay, so all their income that they derive from the trade, from the carrying on of trade, business, profession, or vocation will be accessible under 10(1)(a) source. That means we call it trade income. Okay, the income of the sole proprietor earned from his sole proprietorship business will constitute his trade income, and it will be subject to tax under trade. Okay. I'll move on to the next slide. Okay, just now I did mention, right? Sole proprietorship is the business. Okay, so when we tax in the name of the owner, which is the sole proprietor. Okay, which YA do we tax? Okay, the trade income is assessed in the YA following the year of the sole proprietorship accounting period. Okay, if you look at your slide, you can see this accounting period from January to December. This is what we call the calendar year. Okay, this is what we call it the calendar year basis. Okay, then the second one from April 2020 to 31st of March 2021, this is the accounting year basis. So which means to say that the sole proprietorship, okay, the business can have the accounting period either on a calendar year basis or on an accounting year basis. Okay, if the accounting period is on an accounting year basis, okay, which is like the second one, it ends 31st March 2021. Because it ends in 2021, the income is taxed in year of assessment 2022. I think you're aware of this preceding year basis. So when we talk about year of assessment 2022, we are actually looking at the preceding year income earned. Okay, so if it's on an accounting year basis, we look at the year, the end date, which is 31st of March 2021. So you make it accessible in year of assessment 2022. Okay, the business itself may have non-trade income. Besides getting trade income, it may have rental income, it may have interest income. So depending on what is the accounting year basis, if it's on a accounting year basis, then it will be assessed that even the non-trade income, like interest income or rental income, will be assessed on the accounting year basis, which is that period, the 1st April 2020 to 31st of March 2021. Similarly, donation in the name of the sole proprietorship, that means the business, will be based on an accounting year basis. Okay. Are you okay with it? I move on to the next slide. Yeah. Okay, good. Okay, so the sole proprietor himself, he may have other sources of income other than from this business. Say for instance, he may be an employee, so he would have employment source income. So this is what we mentioned, sole proprietor's other income and donation. So for this other income, like his employment income, it has to be assessed on a calendar year basis. Okay, it cannot be on the accounting year basis. Okay, okay, this is important. The sole proprietor or the self-employed person would have to declare his income from all sources. As I said, a sole proprietor is a person, individual person. So this individual person could be a partner, could be a sole proprietor of a business, could be an employee, and could have rental income, and may have interest income. So this is what we call all other sources of income. So all the other sources of income, including his sole proprietorship income, trade income, he has to declare in his income tax return form B. Okay, clear? Are you all clear? So he has to declare in the form B, income tax return form B, declare income from all sources. Okay, next slide. Okay, partnership. Okay, partnership is when two or more people come together to carry on a business with a view to make profit. So we have generally three types of partnership. We have the general partnership, we have the limited liability partnership, we have the limited partnership. So for income tax purposes, we treat the partnership as tax transparent. And what do we mean by tax transparent? It means to say that we do not tax at partnership level. Similarly, just now I mentioned, the sole proprietorship business, we don't tax at the business level, we tax at the owner, which is the sole proprietor himself, the individual person. By the way, the sole proprietor can be a corporate entity, so will be at corporate rate. Okay, so for partnership, it works the same way. We will not tax at partnership level, but we will tax at the individual owners, which we call them partners. Okay, so it should be at least 2%. Okay, the partners can go as many as, you know, up few hundreds even. Okay, so at least there'll be 2 partners, 2 owners, and we tax them based on their allocated share of profits from this partnership. Okay, okay, taxation of sole proprietorship and partnership. Okay, Jen, this is just an overview on what we're going to touch on. We'll be touching on the income, we'll be touching on deductibility of expenses, we'll be touching on capital allowances, claim, donations, and also we'll be looking at what happens if there's losses or capital allowance to be carried forward, to be carried back, and how do we treat them? So in the later slides, we'll be touching in more details. Okay, when we talk about deductibility of expenses, as I said, the focus will be more on those relevant to our self-employed taxpayer. So a self-employed taxpayer who is carrying on trade, business, or profession can claim what we call Section 14N. Okay, previously was known as 14Q. We call it the R&R cost, renovation and refurbishment. That is when he carry on some R&R costs, work in the office premises, in the business premises, and he's given a deduction. He can claim deduction on this cost over 3 years on a straight line basis, which means, for instance, if he incur costs like 90,000, okay, so over 3 years, divide by 3, 1 year will be 30,000, the following year will be another 30,000, and the last year will be another 30,000. So for 3 consecutive years, he'll be claiming like 30,000 as a deduction. Okay, when we talk about this R&R costs, there's a cap to it, you know. There's an expenditure cap of 300,000. And how do we apply the cap? We apply the cap looking at the individual. Okay, so an individual can own more than 1 business. Okay, the individual can have maybe 2 or 3 businesses, but the cap is at individual level. Okay, then the next sentence is talk about the YA2021 and YA2022. It's only for that 2 YA, we have this R&R cost where instead of 3 years, it's over 1 year. Okay, but now we are entering YA2. Now we are in YA2023. So actually, it's not applicable now already. Okay, the next slide will actually give you the example. Okay, to explain. Okay, how do we do the capping? Okay, you can see from this graph, you can see individual A, he has 3 businesses: business 1, business 2, and business 3. So the cap is at individual A at his level. So the summation of all the 3 businesses, he can only cap at 300,000 for the cost on the R&R cost. Okay, but at partnership level is different. Okay, he may be a partner of partnership 1. So partnership 1 has its own cap at 300,000. So this is what we mean by the cap applies at individual level for businesses, but if it comes to partnership, the cap is at partnership level. Okay, this is an important topic. Okay, pay more attention to it, please. Okay, so this deduction, we call it the fixed expense deduction ratio. Okay, is applicable to certain group of self-employed person. At this moment, it's only applicable to private hire car drivers, taxi drivers, one group. The other group is the commission agent. Okay, so 2 groups. Okay, what actually is this FEDR? Okay, this FEDR is actually the what the self-employed person can elect to deduct, and we call it a dim amount based on a fixed percentage of the gross income. Okay, if you look at the private hire car, you see 60% of gross driving income. So 60% of his revenue from driving, this 60% come out to a figure. This figure is the expenses that he can claim. Okay, it makes things easier for him because he can just opt to claim 60% as expenses. He need not keep records, As a self-employed person, before we had this FEDR, self-employed person has to keep proper record. Even up to now, they have to keep proper record. But the exception is just two group of people if they opt for FEDR. So it makes filing simpler, okay? They need not keep record, okay? They will just say, okay, 60% of gross driving income, I'm okay with it. It comes out like, for instance, 100,000 is my driving earning, 60%, okay, is my expense. So effectively, we are taxing him on net of 40%, which is 40,000. He's okay with it. But of course, if the taxpayer feel or the self-employed person feel that actually my actual expenses are much higher than the 60% or the 25%, then he can opt to claim the actual expenses rather than choosing this FEDR. So there's a choice. Okay, once he decided, he has to adopt that. Okay, next slide is showing example. Oh, we should have an example. Okay, never mind. We go on this slide first. Okay, so for the self-employed private hire car drivers, we have this section in the Income Tax Act. Siu-Lei may have earlier mentioned that for deduction expenses, we actually look at section 14 and we also look at section 15. So section 14 here states that private hire car drivers can claim tax deduction on car related expenses. Okay, this is something new because it's only effective from YA 2019. Before that, private hire car driver cannot claim car expenses at all because it's prohibited under section 15. Okay, with effect from 2017, we have changed the act and we say private hire car drivers, you use your car to earn your income, and this private hire car expense, car rental, fuel, parking fees. Okay, all these expenses we allow you to claim deduction against your earnings from driving. Okay, so this is something new, which we allow them to claim the car-related expenses. Okay, but the purchase cost of the car is not allowable. It's not deductible. Neither will we allow capital allowance on the car. Okay, so it's just the running cost. Oh dear. Oh dear. Oh dear. I think there's some. I'm sorry. I think. Are you seeing what I'm seeing now? Seems there's some problem with it. Oh dear. Are you seeing the slides now? I'm so sorry because it just blank off and I don't seem to see it now. Oh dear. Can somebody help me with it? What are you seeing?
It's okay already. You're seeing the deductibility of expenses.
Do you see anything on the right side, or you just see the full slides?
See the full slide.
Full slides, there's no notes with it.
No.
I don't know why it just blank off and I can't see anything. Okay, I'm so sorry.
Maybe you can try.
Oh yeah. Thank you so much. Yeah, responding. Okay, thank you so much. Okay, so it's still at 11 now. Okay, good. Okay. I was saying that the car-related expenses, he can claim expenses. But okay, what happened if this expenses is so huge that is more than his earnings? Say for instance, he has 40,000 expenses and the earnings is only 20,000. So 40,000, 20,000, he has excess of 20,000. Okay, this unabsorbed expenses, what happened to it? It cannot be set off against his sources, his other sources of income. Say for instance, he may be an employee. Okay, then at the same time, he's a private hire car driver. So he has this 20,000 unabsorbed expenses. Can he use this 20,000 unabsorbed expenses to offset against his employment income? Cannot. Okay, it's quarantined within the private hire car earnings. Okay, And then what happened if this private hire car driver says that, I actually, there's some part of it is private, some part is for chauffeuring, ride services. So then he would have to apportion accordingly the expenses. Okay, we are talking about actual expenses now, because he can claim actual expenses, but the earlier slide did mention that he also can claim the deemed expense ratio. Okay, so this slide is basically talking actual expenses. Okay, I move on to the next slide. Oh dear, I cannot move on. Sorry, what are y'all seeing now? Oh dear, I am at slide 12, but it's like
You're fine, Leanne, you're at slide 12.
I know I'm at slide 12, but I'm not seeing slide 12, I'm still seeing slide 11. Okay, I tell you what, I'm so sorry. I'll stop sharing now and I redo it all over again. Okay? Okay, let me stop sharing. Okay, are you seeing slide 12 now? Good.
Yes.
Okay, thank you so much. Okay. So this is the example. Gross passenger fees 80,000, incentive, rebates, etc. 20,000. Total revenue that this particular PHC driver is getting is 100,000. So if he opt for the deemed expense, the 60% deemed expense, it will be 60,000. So his net earnings is 40,000. Okay, Ken? This is a very simple example. Okay, I'll move on to the next slide. Okay, slide 13. Okay, this one is talking about commission agent. Okay, remember just now I said there's two groups of self-employed person which can claim this, can opt for this FEDR. One is the PHC and the other is the commission agent. Okay, so this commission agent can claim 25% of their gross commission income as deduction. And who are they? Okay, they are the general commission agent, they are the real estate commission agent, insurance agent, MLN agents, and as well as remisier. Okay, there's certain conditions. Okay, they have to be tax residents in the YA relating to the basis period, and they should be carrying on that particular trade, business, profession, or vocation, and incur deductible business expenses. And this last condition is very important. The commission income not exceeding 50,000 annually. So for this property agent, the property agent is a commission agent. For a property agent, okay, for instance, for him to claim FEDR, his revenue must be below 50 or below. Okay, if his revenue is 50,100, then he cannot elect for this 25% gross this fixed expense deduction ratio. Okay, Ken? Okay, this is an example. Okay, say we can see agent A and we can see agent B. Okay, so for agent A, he is both an insurance agent as well as a remisier. Okay, so he has total commission of 41,000 from insurance agent A, from insurance, and 7,000 as remisier. So in total is 48,000. 48,000 is below 50,000. Okay, so if he wants to opt to for this deemed expense deduction of 25%, he can. Okay, but for agent B, okay, agent B is a real estate agent, 55,000, insurance agent, 12,000. Okay, if we add up both, it's beyond 50,000. But we also notice that as an insurance agent, is below 50,000, only 12,000. So can he claim FEDR for the 12,000 as an insurance agent? The answer is cannot. Okay, not qualified at all, because we look at agent B, he is considered as an commission agent. Okay, commission agent, and his total commission that he's getting from real estate and insurance exceeded 50,000. So he cannot opt for FEDR. Okay, non-deductibility of expenses. Okay, this is basically as stated in section 15 of the Income Tax Act. They are those private personal expenses, and they are not deductible as expense for to be against the sole proprietor or the self-employed income. Okay, some examples are the ongoings of a premise used as residence. That means the self-employed person says that I use my house, my house got my house has certain utility bills, and I want to claim some expenses on it. So no, because we don't see this is for his own use. Okay, it's for his private use, so it's not allowable deduction. The sole proprietor's own salary as well is not allowable deduction, because as I mentioned earlier on, the profits of all the earnings that he's getting from the business is all his. Okay, so he cannot less out his own salary. Okay, it's a private expense. Private car expenses cannot allow. Okay, this is important because some self-employed people will say that actually I use my private car for business purpose. I need to travel around. Okay, the insurance agent, good example. Okay, insurance agent or even property agent says that I need to use my private car. I need to show my clients round, which property to buy or whatever. So I use my private car. I want to claim, but unfortunately, even if it's for the purpose of business, but he can't claim this private car expenses under section 15. The only exception was what I mentioned just now. If he's a private hire car driver, then he can claim car expenses, the related car expenses. Okay, then his family personal expenses, medical bill, hotel, holidays, insurance, all this for not for business purpose, okay, is for his own personal. All these are not allowable, and drawings for the business as well, they are not allowable. Okay, just bear in mind that self-employed person, as previously mentioned earlier on by Sule also, that employees, their expenses are very restrictive, because employees basically they don't need to pay for expenses. Okay, they get their fixed salary, their employer will pay for all those whatever expenses. Okay, but self-employed is different because they are the one who is in the position to realize the profit, and the profit is theirs, so they would have more expenses to claim. And but whether we allow as a deduction is a different matter. Okay, they can claim anything, personal expenses, all those that I mentioned just now. Just now we saw at the earlier slide, personal holidays, accommodation, for their holidays, their food, they will claim, but it's not allowable because it's personal expenses. Okay. Okay. Okay, right now we go to the Medisave CPF contributions. Okay, as a self-employed person, if the self-employed person is a Singapore citizen or a Singapore PR with natural income more than 6,000, it is compulsory that he need to contribute to Medisave. Okay, so how much you need to contribute to Medisave? That is the table, and this is from the CPF website. Okay, it's under CPF purview actual Medisave payable, which is based on a certain age and the natural income. But when we come to relief, we would have to look at Section 39H. How much relief we're going to give it to this person who contribute to CPF? We look at three things: actual contribution, 37% of net trade income, and we kept it at 37740. The formula of 37740 is actually quite close to the employee. It's based on 6,000 times 17 months. So basically, you just need to know these three things: actual contribution, 37 of net trade income, and 37740. This is for your information. I will know that there is such thing as a CPF relief for self-employed person, and the tax relief that we're going to allow is based on this, the lower of one of those. Okay. So just now we mentioned that this 37740 is the maximum CPF that is we're going to give them as a relief. So if there is any compulsory, we will allow the compulsory as an employee, and the MediSave portion as a self-employed, the compulsory will allow as a relief. Okay, but the voluntary part will depend on this 37740. Okay, the max is 37740. So if it's already max at 37740 for the compulsory part, there's no more room for the voluntary self-employed contribution. Okay, this is an example. John is a 30-year-old self-employed person. His net trade income for 2021 is 110,000. Okay, and his mandatory MediSave contribution is 5760. Okay, this is based on his age and the net trade income. Okay, if he wants to make voluntary contribution, then how much can he make? Okay, now we look at the 37% of his net trade income. It comes to be 40,700. That's the amount. Okay, the 37% is 40,700, and the capping, the max is 37740. So which means to say that 37740 less out his MediSave contribution of 5760, the maximum voluntary that he can contribute is up to 31980. Okay, next. Okay, this is important. Okay, pay attention to it because we are talking about expenses. Okay, in this slide, we see that there are few expenses that's listed down there, and we would like to know whether the expenses are deductible or not. When we add back, which means to say that it's not deductible. I am not sure whether you all want to unmute yourself and participate in it, or you want to put it in the chat. Okay, first one, upkeep of private motor vehicle. Anybody? Yeah, I think I can't see the chat, Something wrong with the chat. I close it first.
Add back.
Yes, private car, very good. Remember, private car expense cannot allow even if for business purpose. Okay, next one, depreciation. Depreciation is an accounting term, okay? We don't allow, okay? I think maybe earlier on in the corporate module, you may have touched on it. So it's not allowable. Okay, training costs for staff, allowable or not allowable? Anybody want to just shout out the answer for staff? Allow? Yes, thank you. Yes, it's allowable because it's a staff cost. Okay, training costs for Mr. S. Mr. S is the sole proprietor, he's the owner. So pay attention, expenses on himself, his pay, whatever that is he's spending on himself, are they allowable? Not allowable, okay. Okay, R&R costs. Okay, this one we will allow, we'll divide by 3, okay, to give. So we add back and then we give 1/3. Okay, laptop for business use. Anybody want to try? Laptop for business use. Can or cannot? Can we allow? Is as expense? Okay.
For business use?
Yeah, for business use. Can we allow?
Yeah.
Can. Okay. Okay. Laptop is actually an asset. Okay. So this is when we say section 14 is actually for business running costs. So asset, we don't put it under section 14. Okay, so we don't give laptop, but we give it under CA, capital allowance. So laptop is 100% deduction. So eventually we give in that sense. Okay, we don't give it, but we give back under CA. Okay, laptop for child's university study. I think you all know lah. These are all private already because for his child. So cannot. Contribution to his own MediSave. Okay, he's a sole proprietor. Contribution to his MediSave cannot. Okay, contribution for staff. Okay, staff, you know, staff are employee. Okay, so employee as an employer, he will need to contribute to CPF board. Okay, so CPF contribution, yes, it's a staff cost. Okay, next one. Salary allowances for staff. Can? I think you all know, right? Okay, I will just move on. I think somebody posted something. Oh dear, I don't know why I can't see the message. I cannot see the message. Oh dear. Okay, never mind. I can't see. Oh, never. Okay.
Sorry.
Yep.
Sorry, the contributions to Mr. S medicine is add back or is
add back. It's not allowable deduction. Just remember anything pertaining to the self-employed sole proprietor, self-employed person, we don't allow as a deduction, but we can only allow staff costs. That means if he employs staff for his business use, you know, to run a business, he would need staff. Okay, so staff is part of the allowable business expense. Okay, so the earlier one, there's anything pertaining to Mr. S, like his salary and bonus disallowable. Anything for the staff, yes, we can, because it's a staff cost. Okay, next one, fire insurance. Fire insurance for office premises. Fire insurance, yes, we can allow because the office is used for the business. Life insurance for Mr. and Mrs. S, no, cannot. Okay, cannot. Okay. Airfare for overseas business trip. Okay, we see business trip, he need to travel to do business overseas. Yes, we take it as a business cost. Okay, withdrawal of capital, no. Okay, I think you're aware, right? Y'all can, right? Okay. I have to run a bit fast now because now it's already almost 12 o'clock. Okay, then just now remember we say CA, the capital allowance for laptop, we don't give, but we give it under CA here. And then the R&R cost, we give 1/3. Okay, next one. Okay, what happened if the sole proprietor has losses or capital allowance that's not absorbed yet? What can be done? Okay, so for unabsorbed capital allowance, it can be carried forward and be deducted against future profits, provided that the business continues. Okay, that means it's the same business, still doing the same business, then okay, yes, we can allow. So unabsorbed trade losses can be carried forward and deducted against future profits. So this one we need not take a look at whether the business still continues for trade losses. But for CA, capital allowances, yes, we need to make sure that the same business still carry on. Okay, for unabsorbed approved donation, we can carry up to 5 YA against the future profits. Okay, next we have this order of set off. Okay, order of set off. First of all, we will set off against capital allowances, next trade losses, then approved donation. Okay, carry back. Just now we mentioned carry forward, and we also have this carry back. So if there's unabsorbed CA and there's losses, taxpayer can opt to carry back, you know, this to offset the preceding YA. And how much can he carry back? That is the restriction here. It's a lower of 100K, that's the maximum 100K, or the amount of accessible income from the previous YA. Of course, when you carry back, you make sure you carry up to the accessible income. Like you don't carry more than that. You cannot carry beyond that because it make it zero already, so you no need to pay taxes. So you carry back is up to the amount of the accessible income, and it's restricted to 100K. So when you carry back the CA, it's the same business test rules has to be satisfied. So it means to say that right now this person may have unabsorbed CA. Then he wants to carry it back to the preceding YA. Then he has to first consider whether is there any business commencement in the previous YA. If the business has not even commenced yet, then he cannot carry back the CA because he will fail this this same business test rule. But for trade loss, it's different. Okay, we don't look at this business continuity test. Okay, so you can carry forward, you can carry back, even if you have not commenced your business. Yeah, so carry forward, carry back with subject to the same business test for CA, but not for the trade losses. Okay, this one is more for your information because it's for YA 2020 and 2021. Now 2023, or even if we reflect from 2022, we don't have this enhanced. This was during the budget speech where they say you carry back, instead of carry back 1 year, you can carry back 3 years. Okay, so this is the so-called enhanced carry back. So for 3 years, how we see the 3 years, we start off with the first preceding year, second preceding year, YA, third preceding year. Okay, so that's how it goes. So if the YA of the qualifying deduction is 2021, so the first preceding YA is 2020. So you go one more back, 2019, one more back, 2018. Okay, as I said, it's just for your information. Okay, next we go to partnership. Okay, partnership. It's a carrying on a business If they carry on business in Singapore, they would have registered with ACRA, and there should be at least 2% with the intention to do business with profit-making motive in mind. So partnership may have a deed of partnership which spells out, exactly what's the agreement like, how is the sharing basis, and what will be my salary? Will I be getting a salary out of it? So it will be spelled clearly in a partnership agreement if there is a deed of partnership. And who are the partners, of a partnership? We have the equity partner, we have the limited partner, we have the salaried partner. So equity partner is one who contributes a fixed amount of capital and has a share of the partnership profit or loss. This limited, equity partner is actually is another name is unlimited liability partners versus the limited partners. Okay, unlimited liability to the partnership debts, but for limited partners, they are not liable to the partnership debt beyond a certain amount, which is the contributed capital. Okay, so later on, when we are at the slides for LLP, we will have this limited partners when we need to do restriction. That is a very important topic, which we will go into more details. Okay. Next, we have a salaried partner. They are basically like employees getting a salary. Okay, next. Go on to the next slide. Okay, resident status of partnership. Okay, earlier on this morning, we have dealt on individual resident status of an individual. Now we look at resident status of a partnership. Okay, under Section 2 of the Income Tax Act, resident in Singapore covers only individuals, companies, and bodies of person. So partnership fit in any of the description. Partnership is not an individual. Partnership is not a company. And partnership is not a bodies of person, because it is specified in Section 2 of the Income Tax Act that bodies of person, it does not refer to, it excludes partnership. So partnership is not individual, it's not company, it's not bodies of person. So what resident status? We can't. Okay, so we do not have we cannot certify tax residence of a partnership because it's not a legal person for income tax purposes. So what happened is that if there's no, like DTA, they need to certify the partners as tax resident, then we go to the individual partner level. Okay, back to what earlier on Siulei had touched on, that individual person, we look whether are you a tax resident or are you not a tax resident. So at partnership level, no tax residency. Okay, next. Assessment of a partnership income. Okay, earlier on I already said that partnership, at partnership level, we do not tax the income. We tax in the hands of the individual partners. Okay, partnership is not a separate legal entity for income tax purposes. So that's why we say tax transparent. So individual partners are assessed separately on their respective share of profits from this particular partnership. Okay, this is important. Okay, on the filing obligation. So when that is a partnership that needs, the partnership needs to file a form, okay, an annual income tax return form, which is the form P. Okay, who will file? It will be the precedent partner. Okay, precedent partner is responsible to file the income tax return form P. Okay, income tax return form P basically states the business performance of the partnership, whether the partnership is making a profit or making a loss. If it's a profit or a loss, how the profit or loss is being shared among the partners in a certain agreed basis. Like if there's two partners, they may have agreed to share that whatever loss or profit, we share on the basis of 50% each. So if the partnership has a profit of 10,000, each partner will be getting 5,000 each. So the filing of the income tax form P will declare the partnership earnings, as well as how to allocate the partnership loss or the partnership income to each individual partners. Okay, so important point to note is precedent partner is responsible for filing the form P to state the partnership performance, the income. Okay, the precedent partner is an individual person. Okay, remember earlier on we mentioned, so proprietor, self-employed person will need to file a form B. So precedent partner is a self-employed person. Okay, so precedent partner will file a form P as well as a form B, because as a self-employed person, he would need to file his own individual form B. In his own individual form B, he will state his partnership income from this particular partnership, the form P that he filed. Okay, he will declare it as a trade income, that he's getting this amount of share of profit. At the same time, if he's employee, then he will have to declare his employment income. If he has rental income, he will have to declare his rental income in his own form B. Okay, so the total income we will bring to tax and assess in his name. Okay, so I hope you are clear when it comes to filing. Form P is a partnership form. Precedent partner has to file the form P. Okay, if the precedent partner filed the form P, precedent partner being a self-employed person would need to file his or her own form B as well, declaring income from all sources. Okay, Ken? Okay, the precedent partner is defined in the Income Tax Act and is one that is personally present in Singapore. And it's usually the one that is first named in the partnership agreement. So should there be a partnership agreement, we look at the first name. And then if there's no agreement, then in the absence of agreement, we look at the initial, the usual name of the firm, or we use the preceding acting partner if the partner name with precedence is not an acting partner. Okay, so basically just for your information to see how we define precedent partner. Okay, the filing. Remember I say form P, they need to file a form P. So in the form P, they will declare the revenue. Okay, so if the revenue is less than 500,000, okay, simple filing. Okay, you no need to give me statement of accounts or the financial statements. You no need to submit to IRAS the statement of accounts. You just need to declare the 4-line statement, which is the revenue, gross profit, allowable business expense, and the adjusted profit. Okay, with effect from last year 2022, we make it even easier. Okay, we make it even easier. So with a partnership revenue of 200 or less, you just need to give 2-line statement to do, which is the revenue and the adjusted profit. Say for instance, the revenue is 150. Okay, then the business expense 50. So adjusted profit is 100. Okay, so you just need to give me revenue or give us IRAS 150 revenue, adjusted profit is less of the expense is 50, so 100 adjusted profit. Just the 2-line would do. And submission of 500,000 above is only required if submission of statement of accounts is only required if the revenue is 500 or more, and it has to be certified through by the precedent partner. Okay, I'm not sure whether am I going too fast, but I'm trying to cover the slides as fast as I could so that I can have more time for the case studies. Okay, next one. Where there's a partnership deed, it will state, as I mentioned, it will state what will be the fixed payment, which is like partner salary, and how are we going to share the profit or the loss, you know. So it's just spelled out exactly how the sharing basis. Okay. I move on to the next one. When there's no agreement, usually we will take what is declared, okay, by the precedent partner, and it should be reasonable. You know, the sharing basis should be reasonable in the sense that it's like one partner is working, put in more capital, then likelihood that person will be given a bigger share in the profit sharing. Okay. Okay, I move on to the next one. Okay, example of allocation of profit. So we have this this profit which is 24,000. Then we have salaries for A and for B, 6,000 and 4,008. Then we have interest. Okay, salaries and interests are considered fixed because it's not like dependent on the profit of the company or of the partnership, but rather it's fixed given to them. So it's 6,000, 4,008 is fixed, and also the 5% is fixed based on the capital that they pump into the partnership. Okay, this divisible profit is the one that they will share. Okay, should there be any profits, it will be shared in this manner: 2/3 and 1/3. Okay, next we go to the example. Okay, I just show the whole thing. Okay. Okay, yeah, okay. You can see, right? Okay, good. Okay, just now we mentioned adjusted profit is 24,000, right? Okay, 24,000. Then we know that partner A is getting salary of 6,000. So we put in 6,000 here. Oopsie, go in the next slide, sorry. So we have 6,000 here. I'm not sure whether you can see my cursor. Okay, it's 6,000. And then for partner A, partner B is 4,008. So total is 10,800. These are fixed. And then interest also, interest on capital, based on that capital, the interest is at 5%, so it comes up to be 1,000 for partner A and 800 for partner B. So total is 1,008. So we have 24,000 as the profit, but from this 24, we give this salary 10,000 goes back to A and B, and 1,008 goes back to A and B. So remaining 11,000. This 11,000, we have this basis of sharing, the 2/3 and the 1/3. That's how it comes about the 7,006 and the 3,008. Okay, so that's how we will allocate and how we tax partner A. So partner A, what he's getting in total from the partnership is salary 6,000, interest 1,000, share of partnership profit 7,006 on the basis of 2/3, and total so-called income, partnership income that he's getting from this partnership is 14,600. Okay, I'll move on to the next one. Okay, what happens if there is change in partnership, the constitution of the partnership? That means some partner may leave, new partner may enter. Okay, then we'll look at it as that, no, when there's any change occurs in the partnership, the assets is like being transferred to the new partners. So we deem it as so. So once you deem it as so, if there's CA that is CA that was previously given, then we will look at the market price, open market price, and compute BABC to partners, to the seller, that the one who exit will have a BABC, the one that enter, the new one will compute the CA from there. If section 24 is elected, okay, section 24 basically means that it's like continuous, okay, the CA still continue. So we will give it to the buyer. Okay, this is more for your information to know that, you know, once there's change in this partner coming in and partner coming out, how are we going to handle the CA portion? Okay, move on to the next one. Non-resident partners, okay, I'll just briefly go through. We do have partners who are non-resident, and then there may be one group of them. So for more of a convenience, we will like tax them in a group and raise at 22% rather than individually, tax the non-resident partner at 22%. We group them together and tax at the non-resident rate of 22%. Okay, I'll move on to the next one. Okay, this is the LLP. Okay, LLP is just is a business vehicle to give businesses more option in structuring their business activities. So it's formed under the LLP Act, and it's a body corporate lah. Okay, formed by registering under the LLP Act. And the important thing is that for LLP, although the status is a separate legal entity, but for tax purpose, as I mentioned earlier on, we take it as tax transparent. Okay, so just bear in mind, though that is a separate legal entity, for tax purpose, tax transparent. That means we tax in the hands of the partners. Okay, that's one thing that you need to know. Yeah, this is what we say here. There will be like 2 or more partners involved. And for LLP, there is the acronym. They will always have this LLP stated as its name. Again, but again, the filing responsibility is on the precedent partner. So remember, precedent partner needs to file Form P for LLP as well, because LLP is also a partnership. Okay, next I move on. LLP tax treatment, which I already mentioned, that we will tax it at individual partner. So if the partner is a corporate partner, then we'll be taxed at corporate rate. Okay, this is the important, it's an important slide. Okay, please pay attention to it. Okay, this slide, okay, my sharing on the slides are more theory. Okay, when you come to case studies, that is really important because from the case studies, you will know the theory is put into practice and you will understand better. Okay, so right now I just go through in theory, what does it mean? Using certain terms, but when you come to case studies, you will know how to use them, and that is really, really very important. Okay, so the case study is important. I really wish that I have commit some time, to do it in more details with you all. Okay, so I will just run through this. Relevant deduction is the share of LLPCA and trade loss against other income for the year of assessment. So when we talk about relevant deduction, it means to say that how much can we use to deduct against other income. Okay, other income refers to other income of the LLP. Okay, so the partner, because we say we tax at partners level, so the partners may have other income, employment income. So the partner has this maybe CA or loss. Okay, how much can he deduct using the CA or loss against the employment income? Okay, this is what we mean by the restriction. Okay, and we can allow the partner to deduct up to the capital contribution. Okay, we always focus on other sources of income other than the LLP. Okay, so just bear in mind, when we talk about restriction, is always you look at the capital contribution made by the partner, you compare with the relevant deduction, make sure that we cannot deduct more than the capital contributed capital. Okay, should there be an excess, you cannot offset. No, you cannot offset against the other income. Then it can offset against the profit of the same LLP. Okay, examples are actually very good. Then you can understand what does it mean. Okay, I will take a bit of a time to go through this example. Okay, because it's quite important to have a better understanding on what do we mean by relevant deduction and how we kept it within the CC. Okay, just a quick look. You see, look at the CC capital contribution. How much is it? 25,000 for both 2020 and 2021. And look at the other income. Okay, this other income of the partner could be, as I said, employment income or rental income. So we look at partner P. Okay, partner P is a partner of an LLP. So this LLP is incurring losses as well as some CA. Okay, so what happened next? We do the computation. Okay, we look at the other income first. The other income, as I said, it could be employment income. So let's say it's employment income, 25,000. So 25,000 is his income, other income, other than from this LLP. Okay, back to that slide, if you can see that CA is 18,000. Then we have to ask ourselves, can we allow CA against this other income? Okay, when you ask yourselves, can we allow, we have to look at the capital contribution. Capital contribution, 25,000. Okay, capital contribution, 25,000. So 18,000 is below 25,000. Okay, yes, we can give. So we give 18,000. So his other income is less by 18,000, becomes 7,000. So he has LLP loss as well. His share of LLP loss, I go back to the slide. Okay, 3,000. Okay, so 3,000 we give. Okay, before you give, again ask yourself, can I give him this 3,000 as deduction? Okay, my capital contribution is 25,000. 18 plus 3,000 is only 21,000. So it's still within 25,000. So I can give. Okay, so I can give 3,000. So my chargeable income become 4,000. Okay, come the following year. Okay, the following year, his other income is 15,000. 15,000. Then his CA, okay, this part, we'll go back here. His CA is 11,000. Can see his CA is 11,000. But can we give 11,000? So before we give, we always ask ourselves, what is the capital contribution? Capital contribution is 25,000. And we also consider past relevant deduction. How much have we utilized already? We have utilized 18,000 CA. We have utilized 3,000. These are all the relevant deduction for the previous YA. So in total, we have utilized 21,000, which is the past relevant deduction. We already utilized 21,000. The capital contribution is 25,000. So we left with only 4,000. So at most I can allow him is 4,000. So we less out 4,000, his chargeable income is 11,000. So because his loss is, his CA is actually 11,000, but we only give him 4,000, so he got 7,000 to be brought forward. Okay, stays there. We have to track all this LLP CA and the LLP losses to be carried forward. We didn't even touch on the loss 8,000. Okay, so the loss stuck there. We can only utilize 4,000. Okay, so this is how what we mean by this relevant deduction up to CC, capital contribution. Okay, next slide. Okay, this basically gives you a definition of what do we mean by contributed capital. Okay, contributed capital is basically how much you put in to the partnership. Okay, it can be in the form of cash and it can be in the form of in kind. Okay, and make sure that when you put in, that you take it out. If you take it out, you got to less it out. Okay, so certain partner says that I want to park my profit, my profit. I don't want to take out. I don't want to. It's not received. I want to put it in back into the LLP. My profit. So that will also be included in the contributed capital. So basically, contributed capital means how much you put in. Okay, as at that time, as at the end of the basis period. Okay, we move on. Next one. So just now we mentioned in kind, right? It can be in cash and in kind. And in kind, we need the independent valuation report. Okay, listen for your reading. And this is the part where we're talking about past relevant deduction with CC. Based on that previous example, you can see that what we can allow the deduction, it has to be equal to the CC. Okay, in the event that the CC drop, okay, like back to the example. I think later on we have an example. Maybe I just show you. Okay, this example. Okay, yeah, just now the example. Remember, we just 25,000. We utilized 21,000. Then the following year, 2022, and what happened now in this scenario? The CC dropped from 20,000 dropped to 20,000. Okay, that means he withdraw. Okay, this particular partner actually take up some capital out. Okay, so from 25,000 it becomes 20,000. So it drops to below the capital, the relevant deduction, because we already deducted 21,000. Now it drops to 20. So the difference of 1,000 is a deemed income. We take it as a deemed income, and at the same time, we also know that these are actually deduction is a loss. So we take it as a deemed loss. So the moment we deem as an income, we allow it as a deemed loss, and with that, his total unabsorbed loss to be brought forward is 9,000. Okay, 1,000 more plus 8,000, so it's 9,000. So it makes the past relevant deduction equal to the CC 20,000. Okay, I move on to the next slide now. Okay, carryback relief applicable to LLP. So okay, it will still apply. We can apply carryback. Okay, the relevant deduction restriction will also apply for carryback of qualifying deduction. So for LLP partner who says that, oh, I want to carry back, okay, to the previous YA. Okay, what is the CC that we're looking at? The CC must be the end of the basis period relating to the current YA. So the current YA, what is the CC amount? I see what is the deduction that was given, and that amount will allow me to carry back. So the CC is based on the current YA. Excuse me. So sorry. Okay, excuse me. Yeah. So we look at the current YACC. Okay, LLP form may be taken over. May take over. Okay, LLP may take over the business of a sole proprietorship or a partnership or another LLP. Okay, basically it says that there is a change in the business structure. That means from partnership to LLP, sole proprietorship to LLP. But that doesn't mean that the trade has ceased. Okay, the business continuity test may still be satisfied because the same business is still carried on. So for that purpose, we are trying to explain here that should there be a change in business structure, it doesn't mean that the business has ceased. Okay, you may still continue with it. And then for that purpose, we can still, the unabsorbed CA can still be carried forward. Okay, other features of the LLP. Okay, formerly we have this section under 10E, now it's called 10D. I think in the corporate module, you will have dealt with this, that is in the business of making investment. So whatever that is dealt with under the company, it applies here with an LLP. The same treatment applies. So what happens if the LLP says that I assign my economic interest to another person who is not even may not even be a partner? So this, we are trying to explain here that if you were to assign the economic interest, you're still a partner. It doesn't mean that you transfer your partnership share to the assignee. So you'll be still taxed on your share of LLP income. Okay, we move on to the next one. Okay, here. Okay, remember just now we talked about the relevant deduction, whether is it applicable. Okay, for relevant deduction, we always see whether is it the same LLP. Okay, we over apply restriction if it is not the same LLP. Okay, understand? So carry forward for deduction against future income of the partner from the same LLP. So you carry forward and you want to less up against the future earning of the same LLP, no problem with relevant deduction. We can allow, there's no restriction to be done. Okay. Deduction against other sources of the partner. The partner has employment income. I have LLP loss. Can I offset? Then the restriction will come in. You have to look at the CC. What is the CC? Okay, so the restriction will come in if it's not from the same LLP. So same thing, the third example, what happened if it's against the partner's assessable income and it's not from the same LLP of the preceding YA? That means you want to carry back, and then you look at the carry back, you look at it, you say that, hey, it's not the same LLP. Then you will have to do the restriction. Okay, so this basically explain RD relevant deduction restriction applicable is only when it's against other sources of income other than from the LLP, from the same LLP. Okay, Limited Partnership Act. Okay, this is for limited partnership. Okay, Limited Partnership Act was enacted on the 4th of May 2009. So ACRA administers the LPX. Okay, so there's nothing really very different from LLP. Okay, it's still a separate, it's not a separate legal entity, it's tax transparent, and there will be at least one partner, general partner, and one or more limited partner. Okay, for LP, there is this rule that one of the partner must be a general partner. Okay, and then unlimited liability for general partner and limited liability for limited partner. Okay. Tax treatment of LP, as I just mentioned, is the same as any other partnership. We tax in the hands of each partner, and similarly filed by a precedent partner of the LP. And Section 10D, the business of investment, is applicable also. Restriction of set off contributed capital, reduction of contributed capital, past relevant deduction is actually the same as the LLP. We do the same. Okay, in this slide, it mentioned what happened. The partner said, I want to deregister. Okay, I want to deregister with ACRA. As in, I was formerly a general partner. Now I want to be a limited partner. So what do they need to do? Okay, they will have to deregister themselves, and then the general partner who deregister as a limited partner is subject to the relevant deduction, because now that he or she is a limited partner, there will be the relevant deduction rules coming in already. Okay, that's the part where we will compare with the capital contribution, because it's a limited partner. So if the limited partner subsequently change to be a general partner, then it's no longer subject to relevant deduction. Okay. Okay. I cannot really see the chat. No, I'm so sorry. Is there any chat around? Siuli, are you around? Do you see any chats around? There, any?
Yes, they are. I think you have to click. You go to bottom.
I know. I have it, but somehow I can't see I can't see. I can't see. It just hang there. I can't see the.
Okay, I read to you the questions. Is the MediSave contribution rates table provided in the exam?
You won't be tested on that. Okay, no, it's not. It's just know that for self-employed person, you can claim CPF relief, and that is the calculation of such is the lower of the three. Okay.
Yeah, I think the other question is, if one of the individuals quit the partnership, which formed by two individuals, the business will automatically change to sole proprietorship. Is that right? Or need to deregister the partnership first, then the leftover person declare Form B or Form P?
Okay, you're saying that a partnership consisting of two partners, and subsequently the two partners quit and become, or rather one partner quit and then subsequently become a sole proprietorship, right?
Yeah.
Okay. Because you see, when they register a partnership, they will have registered with ACRA. Now that they have changed, they will have to go back to ACRA, because ACRA basically is in charge of the registration. Okay, for tax purpose, we will see that this is a sole proprietorship. So sole proprietorship will tax on the sole proprietor. So if there's any change, they will have to go back to ACRA to inform that this business is now a sole proprietorship rather than a partnership.
Okay, basically they have to inform ACRA about
yeah. Because when they register, they will have informed ACRA. So now that they change, they have to let ACRA know, because ACRA is the authority that in charge of the registration of businesses.
As the last question, for the following year, YA 2023, if there is no injections of capital contribution, then cannot use the 7,000 and 8,000 unabsorbed allowance.
Okay. I think this is a misconception. Okay, a lot of taxpayers have this problem. Okay, when we talk about capital contribution, we are not looking at the incremental. That means how much you inject in that year. You get what I mean? Like for instance, back to the example, we say, I think it's 25,000, right? 25,000 is your capital contribution as at the end of the basis period, the Y. You say 31st of December. We look at it, capital contribution, 25,000 in 2020. Come the following year, 31st of December, 2021, what is your capital contribution? If you didn't inject any, that means the incremental, it still stays at 25,000. Then your capital contribution still remain at 25,000. So we are not looking at, in the year 2021, how much you put in more, but rather we're looking at that time, in that time, the point of time, how much is your CC? Because there are instances where the partner says that, oh, I have this 25,000 there, but I don't want to put in so much. I want to take it out. So the CC actually reduces to a certain amount, because they take out maybe 25,000, just now the example, it was originally 25,000, then later on, maybe the partner take out 5,000. So as at 31st of December 2020, it became 20,000. So there was a withdrawal, you take it out. The CC at that point in time will be 20,000. So we look at the CC at 31st of December, because that's the basis period, the ending of the basis period. How much is the CC? Okay, I hope you understand and I address your question. Okay, as I said, I want to have some time to do the case study, because the case study is really very useful to get a better understanding of the capital contribution. And
but Li-Ying, I think, can you answer the other? There's one more question. For sole proprietor contributions of Medisave and CPA, is it allowable or not allowable? As slide 16 mentioned, it is mandatory.
Okay, self-employed have to contribute to CPF, mandatory, the Medisave portion. Yes, the Medisave portion, there's a rate, as I said, there's a rate to it. But we allow as a relief. We were allowed as a relief. We look at the three. If you look at one of the slides, we have the. Let's see, I go back to it. I see whether I can go back. Where is my Medisave slide? The lower of each. Is this the one? I think we have this one. Okay, this is an important set. Okay, okay, for your knowledge, okay. Tax relief is 39 under section 39 2H. Okay, how much tax relief we're going to give to a self-employed person? That will very much depend on the tree. So if he has contributed mandatory Medisave, maybe 5,000. Okay, under the this 5,000 is based on his age and based on the net trade income. Okay, a certain percentage, maybe 5% or whatever he need to contribute to Medisave, say 5,000. If his net trade income is 100 over 1,000 and 37% of net trade income comes out to be, say, 40,000. So we have a 40,000 there. Then we look at 37, because ultimately the cap is 37,740. So the amount we allow is only that 5,000. Okay, because that is the actual amount that he has contributed. You get what I mean? Of course, he can contribute voluntary contribution, which is to this slide. This slide. Okay, this slide. This slide says that he is both an employee and a self-employed person, and somehow it has exceeded 37740. This is an exception, because when it comes to compulsory, we will allow the compulsory to go. Okay, we will allow compulsory. We allow you to claim 37740 because it's compulsory. As an employee, you need to make this compulsory contribution. As a self-employed person, you need to make compulsory, and it's within your net trade income of 37% of your net trade income. Okay, so if you want to contribute voluntary, no room for it already, because it already max 37740. So for compulsory, we will let you claim, provided it's within the 37% of your net trade income. Okay, I hope I answer your question. Okay, Ken? Okay, next will be I stop sharing. I will show the question. Okay, we have two case study, case study 1 and case study 2. Okay, I'm not sure whether can you all see the case study. Hope you all can see. Can see? Okay. Okay, this case study is very important. Okay, because it actually tests your understanding of what is relevant deduction, how we restrict to the CC. Okay, so I give you all maybe 10 minutes. What's the time now? 12 to 10 minutes. Maybe 12:55. Okay, this 10 minutes for you all to read the question, try to do the worksheet. Question 1 and 2 lah. Okay, I will show the question 1. I'm sure you all have the question 1 and 2, right? Okay, with you. Book on the question 1 and 2. Then after that, we will discuss together. Okay, we need to input the amount. And then I will explain to you all. It will be best if I have a volunteer, to work with me through, and then not to worry about making mistake. Okay, that is how we learn. Okay, if you make mistake, that's the part I will come in and explain to you why is it a mistake and what's the correct way to do. Okay, so we will walk through, okay, together these two questions at 12:55. Okay, yeah, so I just pause here for a while, then you can take a short break also. I will go through the question. Question 1. Andrew's income for YA2021 and YA2022 are given below. Okay, so Andrew is a partner of J&J LLP. So in YA2021, he has employment income of 120,000. And from J&J LLP, he has this share of capital allowance 4,000. And his share of LLP loss is 11,000. Okay, the LLP has other income, rental, which is 1,000. Okay, Mr. Andrews' capital contribution as at 31st of December 2020 is 25,000. Okay, come the following year, his employment income and Mr. Andrews' employment income is 23,000. Similarly, he's still a partner of J&J LLP, and his share of capital allowance is 8,000. His share of LLP loss, 35,000. And his share of LLP other income, which is a rental, 2,000. Okay, his capital contribution has increased. Okay, he pumped in more capital. So it's, as at 31st of December 2021, is 45,000. So we are supposed to compute Andrew's accessible income and relevant deduction for YA2021 and YA2022. Okay, I will go slowly. Okay, anybody want to give a try? Any participant want to give a try? We have this worksheet, which is very helpful because you just need to fill in the figures. Okay, LLP other income.
1,000.
Very good, very good. Thank you very much.
Worksheet going to be given in the exam, or we have to?
No, when yeah. So you take note of the worksheet, okay? Okay, LLP other income 1,000. That's right. Employment income. Anybody just shout out? Then we can go through together. It's very obvious.
120,000.
Yay, very good. Yes, very good. Yes. Okay. Okay. Now, when we come to share of LLP capital allowance. Okay, remember when the moment we want to deduct, we have to think, are we going to allow the deduction? Are we going to allow? So this one is actually 4,000, right? Because it's here, right? Okay. Look at the capital contribution, 25,000. Okay, this is the first year. Okay, we take it as the first year. So his capital contribution is 25,000. So he wants to less out 4,000 CA, LLP CA. Can we allow?
Yeah.
Very good. Why we can allow?
CC
is 25,000. Yes, yes, very good. Yeah, 4,000. So we less out 4,000. Okay. Okay. So when we left out 4,000, how much is the let me see, 1,000 plus 1,000 plus 123 minus 4,000. Okay, 11,700. Okay, so we have 11,700. Okay, good. Okay, next thing, LLP loss. LLP loss. How much is the LLP loss? How much is the LLP loss? Current loss highlighted already.
11,000.
Okay, 11,000. Can we allow? Yes, very good. Can we allow? The question is, can we allow 11,000? Okay, I park the 4,000 here so we can monitor the relevant deduction. I park it here.
I'm
Can
sorry,
we allow the 11,000?
117,000.
Oh, sorry. I put in I don't have a zero. Okay, so the 11,000 is the LLP loss. The question now is, can we allow this 11,000 to offset against the 117,000? If yes, what is the reason?
Because still within 20,000.
Yes, very good. Yes, because the capital contribution is 25,000. So we only utilize 4,000. So we still have room for it, right? Okay, so 11,000 less off. So we put here, we park it. We park it because we need to monitor. We need to monitor how much we have deducted, which we call it relevant deduction. So so far we have deducted 4,000 and 11,000. Okay, so 4,011 we have deducted, we park it here also. Okay. So far okay with you? Okay, carry forward, don't have because we fully utilized. Okay, the 4,000 we already utilized, so it's 0. The 11,000 we have also utilized, so it's 0. Okay, so relevant deduction. Hey, why I put in 1? So 11. Okay, so relevant deduction, that means how much we have allowed him to offset his other sources of income is 15,000. Past relevant deduction, because this is the first year, so there's no previous YA2020, so it stays with 15,000. Okay, everybody okay, understand this part before I move on? Okay, now I move on. Okay, come 2022. Okay, we look at LLP other income. Somebody shout out, what is the LLP other income?
8,000.
2,000, yes, 2,000. 2,000, okay? You just fit in the figure. Employment income?
23,000.
Employment income? Yes, 23,000. Okay, you see we are looking at, you notice that we are looking at other income. LLP other income is rental income. Employment income is employment income other than the LLP. So basically, these are all other income other than the J and J LLP income. So this is what we mean by other income. Because they are other income, we are asking ourselves, can we allow the deduction against the other income? Okay, so the deduction now we look at share of LLP-CA. How much is the share of LLP-CA that we're going to less up against the other income? Okay, it's 8,000. Can we allow first? Can we allow 8,000? What do we need to look? Anybody want to try?
I think we can because
YA20. Sorry?
contributed
think can
capital
because-
is 45. Contributed capital
Yes,
is
good.
45, yeah.
Yes, good. Yeah. So important thing, just now I didn't put in, your first thing you have to put in the first thing, slot in the 45,000. Okay, then it's clearer to you. So you slot in 45,000, you will know already. Okay, so if you slot in 45,000, 8,000, we still have room for it because it's only 8,000, right? We have utilized 15,000. Okay, we have to bear in mind the past relevant deduction 15,000 also. So we utilize 15,000. We can still have room for 8,000 because the capital contribution is 45,000. Okay, so how much is it left now? So it's 2,000 plus 23,000 minus 8,000. 17,000. So his income becomes 17,000 now. Okay, with an income of 17,000, how much loss are we going to, LLP loss, are we going to give it to him to offset?
22,000.
Huh?
22,000.
Okay, his LLP loss is 35,000. You can see from the question for that YA2022. So it's actually 35,000. Are we going to put in 35,000 here? Or you I think you give me 20 something because you take 45 minus all this and 22. Okay, you see the accessible income, we want to put it to 0 because we do not need to set off so much until it becomes a negative. We just need to put it until 0. You get what I mean or not? So the most we want to set off is 17,000 because ultimately it's 0 income. So nil. Okay, so we will utilize 17,000 is good enough already. Okay, can we utilize 17,000? We can. Why we can? Because the CC is 45. We have utilized 8,000. Okay, must park here 8,000. We have utilized 17,000. Okay, so far, how much have we utilized? 17,000 plus 8,000 plus 15,000. 40,000. You all follow me or not? 40,000. 15,000 was the past relevant deduction. 15,000. Okay. We utilize 8,000 CA and we only need to utilize 17,000. So the question before we key in, we ask ourselves, can we allow 17,000? The answer is yes, because it's still within 45,000. Because when you add these three, 8,000, 17,000 plus 15,000 is only 40,000. Okay, understand, Ken? So this one will be accessible income is nil, carried nothing already because we utilized the 8,000. This loss, how much we left with? Anybody want to give a try? We still have some loss left over.
18,000 is it?
Okay, the loss is actually originally is 35,000, right? You go back to your question, you can see. I wonder if I highlight here, can you see or not?
Can see.
Can see, okay. Remember the loss is 35,000. You utilize the loss 17,000 only. Correct? So you're right. 17, yeah, you're right. Yes. So it's actually 35,000 minus 17,000. So it's 18,000. Yeah, doing very well. Okay, 18,000. So remember we have to monitor the relevant deduction. So this one 8,000 plus 17,000, 25,000. Okay, so far 25,000. 25,000. 25,000. Okay, 25,000. Okay, so how much is the past relevant deduction? Carry forward. This is the miss. When we talk about this, we are talking about past, previous YA. What is the relevant deduction that we have deducted, and the current one. So everything add together. It's 15,000 plus 25, right? That is the total. We have to track. We have to track how much we have given. So it's 40,000. 40,000 is actually 15,000 plus 25. Because 25 is the current YA 2022. 15,000 is the previous YA, which we call it past relevant deduction. So we have 40,000 that we have deducted so far. Are you following? If you're okay, then I move on. Yeah, okay, move on. So this is number 2, question 2. Andrew would like to carry back any unabsorbed CA for YA 2022 to YA 2021. Compute the accessible income for YA 2021 after carry back and the relevant deduction. So basically it's saying that, okay, Andrew knows that he has this amount, okay, this amount, or this, he wants to carry back, since my current YA is already not very stable. Can you all hear me or not? Okay, his accessible income is already new, okay, but he has this unabsorbed loss. if he didn't elect, you'll be brought forward. So he says that he wants to carry back because his 2021, he has quite a high income, right? Okay, so he wants to use his loss to offset against the previous YA. Okay, so we compute now. Okay, so basically we recompute the whole thing, and I will just fetch it through. I will just look at the 2021 and key in exactly. Okay. Okay, so this is what happened. This is what he previously. Okay, then previously it's, so he left with 11700. Okay, then we have the share of, left out a 0. Okay, so correct or not? This one. Minus 11,000. There's another 11,000. Yep, there's another 11,000 here. 2, 3, okay. So we left with 106. Okay, that was here. Okay, we left with 106. Okay, this is the partner. LLP loss carry back from 2022. Okay, can we give the full 18,000 or not to carry back? Remember one of the slide I did mention about the CC. We look at the current year CC. Current year CC is 45. Correct? Current year CC is 45,000. We have utilized 40 to offset against the other sources of income. So anybody can help me? How much can I put in here? Can I put in 18,000? Or should it be another figure? Anybody want to give a try?
So is it you can only use up to 5 because it's already 40, is it?
Sorry,
Oh,
5,000 is,
yeah,
yes,
5,000.
yes, 5,000. Good, you're right. Okay, that's why when we look at the slide just now, we can only understand the theory. Okay, when we do the work, the case study, we will apply what we learn and we put it here. Okay, one of the slide did mention, we look at the CC of the current YA. The CC of the current Y is 45,000 and we have utilized 40,000. So we only left with at most is 5,000 only. So even though he has 18,000, we can only give 5,000. So this is the important point here when you carry back. Okay. So we have 5,000. So in the end, his accessible income is reduced by 5,000. It brings him to this amount. Okay. 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 So all these things the same because these are what has been previously given before. So it stays with it still. Okay. We just decide how much to give, how much to carry back with me. So all this stays as it is. Okay. So right now we will have 4,000, 11,000. These are all the deduction and another 5,000 here. In total, 20,000. Okay. So you will see that YA2021, we actually utilize 20,000 instead of previously 15,000. Correct? Because the additional 5,000 comes in. Current YA2022, we utilize 25,000 relevant deduction. 25,000 plus 20,000, this is the capital contribution. So it's equal. Okay. Are you okay with it? If you're okay with it, then we move on to the next one. Yeah, I think there's no question, right? Let me see. Let's see whether I can see the question or not. Check. Okay. I think you're okay, huh? This is a very, yeah.
Sorry, in the slides, right, there was something where you talked about precedent partner. How do you determine?
Precedent partner.
Precedent partner.
Yeah. First name. Okay, precedent partner, because you see a partnership will have a lot of partner. Okay, a partnership will have a lot of partner, at least 2 lah, because that's why we call it partnership. Unlike a sole proprietorship, only one owner. Partnership will have a few owners, and these owners are called partners. So among all the partners, there should be one precedent partner, so-called like main partner. Okay, this main, because we cannot be communicating with all the partners, so there should be a main partner that's in charge of filing the Form P. So the precedent partner will be one. Among all the partners, there will be one of them. And how do we identify? Okay, it was in one of the slides in the Income Tax Act, it will be the first name in the partnership agreement. So should they come up with a partnership agreement, there will be somebody named first of all. So that would be the precedent partner. But just for your information, the partnership can always change precedent partner, because partner come and go, the sort of thing, you know, suddenly the partner say, I don't want to be precedent partner. So they can actually like among themselves decide, okay, you have this first name already. Later on, another partner comes in, or I think another partner should be the one. So they will identify another and they will write into IRAS and say that so-and-so is no longer the precedent partner. Now the new precedent partner is so-and-so. So we will also accept, okay? Basically, it's more of communicating with a partner for partnership matters. So this precedent partner is in charge of filing a Form P. Annual filing, there will be income tax return Form B and there will be Form P. Form B is for individual, self-employed person. Form P is for the partnership to file. So this precedent partner, he will file on behalf of the partnership, the Form P. At the same time, this precedent partner is also he himself a partner. He would have a Form B because he will have to file individual income tax return Form B. So he will have to file both in the end. You know, one is for the partnership at the partnership level to declare the partnership earnings, the partnership profits, how it's been shared about all the partners. Another one is his own. His own, that means his share of allocated profit, he will declare in Form B. He may have other sources of income. One example is he may be also an employee. So he will declare his employment income. If he has rental income, he'll declare his rental income. So basically, I'm trying to explain that the precedent partner will file two returns. One is a Form P, one is a Form B. The Form B, he will declare income from all sources, including the partnership, the share of partnership, of which he's the precedent partner. Okay, does that answer your question? Okay.
Yes,
Okay, Ken, very good. Okay, I think I better move on to the next one. I also don't want to hold you too long, but these two examples are really very important. So please follow through with it and pay attention to it. Okay, I will stop sharing this. I will move on to the next one. Okay, next one is case study 2. I think you're saying the correct one right now. Big, okay. Case study 2. Okay, case study 2. Okay. Case study 1. Okay, case study 2. Okay. Okay, for case study 2, Shanti commenced an LLP business. Okay, that is sometime in 2020. So her income for YA 2021 and YA 2022 are given below. So in YA 2021, we see that Shanti has employment income of 39,000. Okay, from Sense Cafe LLP, she has a share of capital allowance, 13,000. And she also incurred share of LLP loss of 53,000. Okay, her capital contribution as at 31st of December 2020 is 50,000. Okay, so these are the facts. Okay, we come the following YA, the so-called current YA, 2022. Okay, similarly, she has employment source 40,000, and for Sense Cafe LLP, she has this share of capital allowance 5,000, and share of LLP profit is a profit. Okay, this is a profit, so no longer loss, it's a profit. Okay, 28,500, and the capital contribution it remains the same. Okay, at 50,000. Okay, now we work on her YA 2021. Okay, by now I think, okay, this presentation is a bit different because we want to ascertain what is the unabsorbed LLP loss, and because there is a LLP profit, we want to less off the CA and the losses against the profit first. And then after that, we work on the employment income. Okay, so LLP loss, just simply plug figures. LLP loss, LP profit, sorry, is a loss, so no, so it's zero, zero. Everybody get that right? It's zero because it's a loss. Okay, any CA brought forward? Nothing, because it's just started only. This one, that is, how much is it? Current CA?
15,000.
Yeah. It may be quite obvious, but I just want you all to speak it out so that it makes you think also, Okay, so LLP loss brought forward, zero, because it's the first year. Okay, then 53,000. Say out already. 53,000 is the LLP loss. Okay. So we just want to ascertain how much the total. Okay, so it's both add together. 13,000, 66. Okay, 66. So we have a 66,000 here. Okay, so these are the unabsorbed, both LLPCA and LLP loss. Okay, move down a bit. Okay, employment income. Somebody tell me the figure so I can just put in employment income.
39,000.
Yep. Yes, that's right. Thank you. Okay, LLP loss CA. Okay, this one is brought forward lah, so don't have lah. Or here is it brought forward or don't have? Okay. Current one, current CA. I just plug in the figure. I take it that you all know. Okay, it's 13,000. Okay, plug in the figure. Okay, loss this one Okay, before I put in, I always ask myself first, and I want to ask you all, can I offset against 39? Because before I allow it, now I'm offsetting against employment income already. So to ask you all, can or cannot? What is important for me to put in here? Okay, 50,000. Capital contribution 50,000. So before you even put in 13,000, ask yourself, can I allow Shanti to offset 13,000 against 39,000? Can or cannot? Yes or no?
Yes.
Yes. Because is the capital contribution is 50,000, 13,000 is below 50,000. Okay, next. Then we look at it. Okay, she has 39,000. Employment income, you minus 13,000. So it's 26,000. So her income now become 26,000. This 53,000. So we no need to put in 53,000. We at most put in 26,000. Okay, I just park it here first. Then we ask ourselves, can we offset or not? We at most, because we the main thing is to get the accessible income zero. Okay. So this one is 39 minus 13 is 26. So we know that there's 53,000, but we don't use 53,000. We just need 26 will do. 26 can we allow? Okay, every time when you put in, you ask yourself, can I allow this relevant deduction? Then we look at the capital contribution. Capital contribution 50,000. You less out 13,000. 37. So you still have room for it. Okay, so we allow. Understand, yeah? Allow 26. 1, 2, 3. Okay. Then, okay, 50. So this one will be 39, 39,000. Yes, 39,000. 39,000. 39,000. These are what we have deducted so far. Okay, then we see what is the CA carry forward. We utilize already, okay, the 13,000, so nothing to carry forward. Okay, all this track. You all know why zero, because 13,000 already utilized. So CA carry forward, zero. Okay, unabsorbed LLP loss carry forward, how much is it? Okay, we have 53,
27,000.
Sorry, how much? 27, yes, good. Yeah, 27,000. 27, you know why? Because it's actually 53 minus 26 because we utilized only 26. So we still got remainder 27,000. So we park there first. We put it there first. Okay. Okay, come the following year, YA2022. Okay, YA2022, compute Shanti's accessible income. Okay. So it's a profit. Okay, so we put a profit there. How much is the profit? Let me see, 28,000. This is LLP profit. Okay, we will less out the CA and the loss, the CA on the carry forward losses, whatever, against the LLP profit first. Okay, so we have this, and let me see, LLP carry forward 0, don't have this. 0, okay. Okay, how much is it? 5,000, correct? You can see allowance. Can you see? I take it that you all understand, because the CA for the current CA is 5,000. Okay, just plug in the figures. So make sure you understand why I plug in this figure. Okay, I just simply plug in. Okay. Then now loss brought forward. Loss brought forward, you got to look at YA2021 already because it's a brought forward. So loss brought forward. This one, correct? Everybody got the figure? Can? It's a brought forward figure. So already computed the brought forward figure. So we just put it here. Okay, 27. You notice I don't care about the restriction here because it's the same LLP profit. Okay, so I just put it in, plug in, and then I want to see the end result. What is the end result? Okay, so what I have here is, this one is a minus, just put a minus, Okay, so we have 28500 minus 5,000 minus 27,000, 3,500 minus. So we still have remainder of unabsorbed CA loss, CA and loss 3,500. It should be a loss. Okay, unabsorbed LLP loss of 3,500. Okay, now we work on the other income. Okay, the other income will be employment income. Employment income 40,000. Okay, employment income 40,000. And let me see, we brought forward don't have. Okay, LLP loss. Okay, we see here, this is the figure, LLP loss, we minus off 3,500. Are you following? Okay, everything okay? Okay, because this is the loss that we have computed. Okay, the 27,000 we offset already, so remainder is 3,500. So we put here a loss. Okay, when we put the loss, this is the part you got to think. Always remember, because employment income is other income. So when we touch on other income and we use the LLP loss or the CA, we have to ask ourselves, can I allow this 3,500? Okay, can I allow the 3,500? Then you have to look at the capital contribution. Capital contribution is 50,000. So 3,500 can go because capital contribution is 50,000. Even your relevant, past relevant deduction is 39, you add in still within the 50,000. Okay, so remember every time when you put in, ask yourself, can I less out or not? Then you check with your capital contribution. Okay, 3,500, we check, we put 3,500 there. Okay, so we less out, what happened to our accessible income? Minus 3,500. Okay, 36,500. Okay, 36,500. So the accessible income become 36,500. After we less out all the losses, the CA, it becomes 36,500. Okay, now we track the relevant deduction. 3,500 is for this YA2022. We utilize already. Then let me put here again. So now we want to know in total how much have we used. Okay, we have to track. 39,000 was for back years, YA2021. We utilized 39. This year, current year, 3,500. So 39 plus 3,500. Okay, I utilize 42. Okay, still good because it's within 50,000. Okay. Are you okay with it? Okay, we are actually now it's like 1:30. I will quickly go through some of the main points. And as I said, do you have any questions on this? I think you're okay, right? Quite clear, right? Because I really go very slow into each of the figures to make sure that you all know exactly where to put in. I suppose the answer, TA will send it, will send it to you. I think it will be made available to you. Okay, the worksheet. So the answer, you take a look and try to do it on your own again and practice on it. Yeah, as I said, it's very important that you know how to compute the accessible income of the partner. Okay, so that's about all. I'm not sure whether there's any questions. Okay, there's no question. Okay, I will briefly run through because I also don't want to take up too much of your time anymore. Okay.
Oh, sorry, Miss.
Yeah,
May
yeah.
I ask a question?
Yes, can.
In the exam, should we insert negative sign or bracket?
Oh, it
for
doesn't
those
matter.
who-
Doesn't matter. Whichever you want. Bracket is the common one. It's just that I use negative. Should be bracket lah, but it doesn't matter to me as long as I can see that your intention is to less, because the word less is there already. So I know. It's for your own. You want to use also can.
Even if we don't insert negative sign or bracket, also can lah.
It's better for you, actually, because I don't want you to. If you don't put in, then you've forgotten. You don't know whether add or minus, the sort of thing.
So in this case, like your YA 2021, right? The less LLP current CA, it should be minus or minus lah. All this should be minus.
Yeah lah, correct lah. You're right also lah. Yeah, right also. Yeah, minus sign. Yeah, because it's actually the amount is as long as you understand what you get, because ultimately is the accessible income. How
about the unabsorbed LLP CA loss 66,000?
Which one?
For YA 2021.
Which one?
The 66,000. Should it be
66,000.
bracket or negative sign?
66,000.
Yeah.
Actually, it doesn't really matter. You can just put in the 60 because it's a less, and we are tracking. You can put a negative because it's unabsorbed.
Okay, sure. Thank you.
For me, I'm not too particular lah, because I said important thing, you know that 66 is something that you can utilize. Okay, so when you do, if you do your accessible income, that is the important one. That is the part. If it's lost, it's better that you put bracket or minus. That ultimately you know. This is just checking on the amount of unabsorbed CA and the unabsorbed loss. So if you put bracket or you don't, it's still the unabsorbed amount. Can? Okay, I will quickly go through. I also don't want to take up too much of your time because it's really like past 1:30 already. Okay, let me see. I got some notes. I'll just do a recap now, okay, on. Okay, sorry. Okay, some learning objectives. Okay, so far we have gone through case studies, and to arrive at the accessible income, you need to do some restriction. Okay, so you should understand that is important concept of the relevant deduction, past relevant deduction, and the capital contribution. Okay, and next thing, it's important that you know what are allowable business expense. As I said, sole proprietor, self-employed person, they relatively should have more expenses claimed as compared to an employee. And when they make claims, to them is deduction, but to us, we are governed by Section 14. So it may not be an allowable deduction. Okay, so the expenses, they can just put anything they like, okay, deduction. But when we look at it, we have to examine, does it fall under Section 14? And does it shows that it's prohibited under Section 15? So the important thing also to note that for PHC, private hired car, we will allow the running costs of the private hire car, but no CA. For other self-employed person other than a private hire car or taxi driver, commission agent, we cannot allow them to deduct private car expense because it's prohibited under Section 15. So the only rare one or the only unique one is the private hire car, which is just recently in YA 2019, we allowed them to deduct the expense, the car related expense in respect of the private hire car. Okay, so other expenses, just be careful. Sole proprietor, their own salary, their own MediSave payment, their own CPF, whatever they pay, or their whole holidays, private car, we don't allow, even for business purpose. Okay, all this we won't allow at all. Okay, this are all disallowable. Okay, but if it's like staff costs, staff salary, staff compulsory, employer need to contribute the CPF portion for the staff, yes. All this is considered staff costs. Okay, so just bear in mind on the concept of what are allowable and what are disallowable. And another important thing to look out for is the FEDR. Okay, I emphasize on FEDR because it's only unique to two categories of taxpayer, and they are the PHC drivers, taxi drivers, and the next group is the commission agent. So remember the 60% of gross revenue or gross drive, 60% of the gross driving earnings. This amount will be the deemed expense, and the taxpayer or the PHC driver need not give IRAS the records or the itemized breakdown of the expenses. It's just a figure that is acceptable. 60%, I will tax you at net, and then they have an option to choose. Of course, if the PHC find that, oh, my actual expenses is much higher than that, I want to claim more than 60%. By all means, you can claim actual, but do show IRAS what are the item. You will have to keep proper records. You will have to itemize and come to that amount. What is the amount, and you will have to present it, show it to IRAS. Okay, so for commission, another thing important is the income threshold. Okay, you have to look to all. As a commission agent, I may be a reminder getting commission, I may be a property agent, I may be insurance. So everything sum up together. Is it more or less than 50,000? Exactly 50,000 can still go for the FEDR. If it's 50,000, $1 cannot, because it's exceeded 50,000. So remember the threshold of 50,000. So if it's like 50,000, $1 revenue, what happened? You will have to claim actual expenses. FEDR is no longer an option for the commission agent. Okay. Then just now I mentioned about filing requirement for Form P, for Form B. Form B are the self-employed person. Form P is the PP will have to file a Form P. So basically, these are some of the important things that you need to take note of. Okay.
Yeah, one last question. Sorry, I don't want to hold you back. Understand very late. For all these partners and sole proprietors, I understand they are taxed based on individuals. But my question is, once they file all this tax, right? Okay, do they still have to file one more time for individual?
Okay, they would have filed Form B. That's individual tax. They okay. You see, partnership will have a Form P. That's at partnership level. The person who filed is a precedent partner. So he is a self-employed person. So he will have to file his own Form B. But you're talking about sole proprietorship. Sole proprietorship is a business. Sole proprietorship business, there's no form. Okay, we don't issue a form to a sole proprietorship business. We will issue directly to the owner, which is the sole proprietor, a Form B. So if the person is a sole proprietor or a self-employed person, he will receive a Form B. And that Form B is for him to declare his income from all sources. Okay. Form P is at partnership level, which is only filed by precedent partner. I hope you understand that point.
Okay, I understand. So Form B for normal partner, and Form P for an individual who can be a sole proprietor.
Form B for all partners, because they are self-employed. Form B for all partners. But I just want to emphasize the point that precedent partner has an additional duty. On top of filing his own Form B, he will have to file a Form P, the partnership form. It's just that only. Because a precedent partner is also a partner, he is classified as a self-employed person. So all self-employed person need to file Form B. So all partners would need to file a Form B. But precedent partner additional duty. You need to file a Form P. Okay?
Okay.
Okay. It may be a bit confusing. Okay, just remember like self-employed person Form B. Everybody, all the self-employed person must file Form B. Okay? Precedent partner additional, you got to file a Form P for the at partnership level.
Understand.
Okay, very good. Okay, thank you so much. If you have further question, as what Siulei say, you can write to TA, and we'll try our best to answer your question. Yeah.
Can I ask the last question?
Sure.
Definition of business, the exam format, will you be able to share with us? Is it purely computation or there's a mixture?
I can't really divulge much, but okay. It's 10 marks, and there will be short answers, and there'll be computation. Okay. There will be there'll be 4 questions. I think 3 or 4 questions. But each of the question there will be sub question also. So it's like 1 mark, 2 mark, the sort of thing, so that it helps you all, at least it's not so heavy, so you will score more marks on that, so hopefully, I just wish you all the best. Okay, as I said, if you follow through my my teaching, the slides, and with the case studies, I think there shouldn't be a problem with your exam question. Okay, I wish you all the best. Okay. And I think the TA has to show you all the
I need to flash the evaluation.
Thank
the
you.
evaluation.
Thank you.
Okay.
Yeah.
Thank you. You all do the evaluation for us. Thank you very much. Have a great day.